I think the U.S. election just hasn't had the sticking power because, again, there's no conviction.
On the other side of the election, we're going to continue to grow.
The tactic of using tariffs just creates a lot more volatility, a lot more uncertainty around growth.
No matter who wins, this friction with China, this tech battle is going to continue.
Whether it's a Democratic sweep or a Republican sweep, that would imply a much bigger deficit.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday with equity markets on the back foot and bond yields near the lows of the year. Equity futures right now negative 0.25% on the S&P 500. Live from New York, we begin with our top story. Fireworks in Philadelphia.
She has no policy.
His plan is to do what he has done before, which is to provide a tax cut for billionaires and big corporations.
What they have given to China is unbelievable.
His next big court appearance is in November at his own criminal sentencing.
In Springfield, they're eating the dogs, the people that came in. They're eating the cats. They're eating the pets of the people that live there.
The President of the United States incited a violent mob to attack our nation's capital.
I probably took a bullet to the head because of the things that they say about me. They're the threat to democracy.
Donald Trump was fired by 81 million people, and clearly he is having a very difficult time processing that.
Now, what can investors do with all of that? Equity futures down 1/3% on the S&P, a bit of underperformance from the small caps on the Russell right now. This is what the picture looks like. We're down by 0.5%. Bramo, on the margin, is that the market casting its vote?
Right now, it seems like on the margin, there was an unwind of the Trump trade. In other words, are we taking a look at what the Harris trade means? It means Bitcoin lower. It means small caps lower. It means a question around taxes. It means a question around regulation and how much that could actually hamper the bottom line for a number of companies. On the margin, yes. On the whole, did it really move the needle? Even the Wall Street Journal and Fox News came out and said Kamala Harris won the debate. Whether or not that has a lasting effect at a time where there aren't that many undecided voters, unclear.
Let's discuss where the former president really struggled. There were two objectives coming into this debate for many people on the Republican side. One, define the vice president. And two, when you hear all these promises about what she's going to do, ask her why she hasn't done any of it while she's sitting right now in the current administration. Failed at the first and waited until the very end of the debate to address the second.
Yeah, Jonathan, I completely agree. I was pretty stunned that he waited for the last moment to say, you've been in power for 3.5 years. You talk about all these, quote, wonderful things. Why haven't you done it? Vice President Kamala Harris did a very good job painting Donald Trump as the incumbent, not herself. She didn't answer a lot of the questions about her flip-flops. And when he was given this moment to really go after the current administration, how they've really wavered on immigration and they're changing policy stances, he was given that layup and he said, first, I want to correct her on the size of my rallies. That was what was more important to him at that moment.
Taking a bait, repeatedly taking a bait. The story moves on this morning. For the market, the focus is on 8:30 Eastern time, 2 hours and 30 minutes time. We focus on CPI, the last big data point going into the Federal Reserve meeting on September 18th. And for some people, I stress for some, perhaps the difference between going 25 or 50 next week.
I think we should stay on the some people. I was trying to get super excited about CPI and say, look, this is going to be the game changer before next week on Wednesday when the Federal Reserve decides between 25 and 50 basis points of a rate cut. 22V research came out and showed that roughly 48% of investors surveyed expect this to be a negligible or mixed report. 32% said risk on and only 20% risk off. Nonetheless, the bias of risks here is that this will allow the Fed to basically write off inflation as one of the parts of their dual mandate and focus squarely on the employment picture.
Let's talk about what's been developing in the bond market. We've got a 2-year yield this morning at the lows of the year. The 10-year yield is down every single day in September. 7 consecutive trading days. We haven't had a single session in this month so far where the 10-year yield has traded higher. The demand for sovereign debt on both sides of the Atlantic has been absolutely massive.
There was actually an auction yesterday of 3-year treasuries, and it was incredibly bid up. You saw it trade through the initial selling price in terms of yields where they were lower. What we can see right now is people are looking at inflation and saying, we expect it over the next 10 years to be the lowest since the beginning of 2021. That's what you're seeing from the 10-year break-even rates. This is a market that is saying, wait a second, all those people saying that maybe this is a new neutral rate, not so fast. And I think that reassessment is really clear in market pricing.
Yields down 2 basis points. The 10-year right now, 362. The bigger picture, the broader picture across asset equity futures a little softer. We're down 0.25% on the S&P 500. In foreign exchange, the dollar's weaker against the bulk of G10. Euro dollar 110.40. Positive there by 0.2%. And taking a bit of a bounce. Crude, after getting absolutely hammered once again. We are in the 60s on WTI still. Lisa, 67.48. The bounce is 2.6% this morning.
Here's my question. Is the decline that we've seen in oil prices a feature of the soft landing or a bug in the soft landing? Does it hint at weakness elsewhere that is also present in the United States? Or is it a disinflationary kind of pressure that's going to allow the Federal Reserve to really continue to cut rates without seeing that recession? I don't understand why we are seeing oil prices roll over to such a degree if you've got Francine and the potential disruption there, if you have ongoing activity, and if you see an ongoing recovery. Something doesn't work in this particular equation.
It's been a big 24 hours in this market. Here's your lineup this hour. Cameron Dawson of NewEdge Wealth seeing more downside risk to growth. Heidi Crebo-Rediker of International Capital Strategies following last night's debate. And Michaud Darda of Roth ahead of the latest inflation data dropping at 8:30 Eastern Time. Let's begin the morning in Philadelphia, Pennsylvania, where Bloomberg's David Gura is standing by. David Gura, quite a night. Good morning, sir.
Good morning to you all as well. And I think, back on the last conversation we had after the first debate between Donald Trump and Joe Biden, we were talking a lot about Donald Trump's surprising discipline. And for me, that is the biggest contrast that I can remark on from what we've seen then and what we've seen now. This debate started with a question about the economy, a question to Kamala Harris. Are Americans better off than they were 4 years ago? She moved away from that rather quickly, didn't answer it explicitly, and that was a moment, an opportunity for Donald Trump to respond and to lay into what you've been talking about, inflation, the state of the economy, issues that could be tied to her being in this administration, and he didn't go there. He talked about immigration. So at that moment, I thought, okay, maybe he's on message, maybe he's being disciplined. We knew he wanted to talk about immigration policy, but it became a thing that he went to over and over again over the course of the night, and not in a very policy-focused way, of course, but talking about conspiracy theories, bringing it up really in answer to any number of questions, any number of topics. I think that there were just missed opportunity after missed opportunity here by the former president. By no means do I think that this was a great night for him. As Anne-Marie was saying, he didn't get to the economy, didn't tie Kamala Harris to Joe Biden until the end of the debate. And really didn't establish for people what he set out to do going into this. That is that level of continuity, that effectively a vote for Kamala Harris would be a vote for another term of Joe Biden in office. The policies aren't that fundamentally different. And I think that he just espoused so much here that would make people worried or concerned about his focus on the job. It's going to be something he's going to have a hard time kind of repairing in the coming days. Now, look at where these candidates are going to go. They're going to try to carry this momentum going forward. Kamala Harris going to North Carolina, such a crucial swing state later this week, coming back to Pennsylvania on the heels of that. Donald Trump going to Arizona, then to Los Angeles. He's going to have a press conference out in California, something he's hit the vice president on over and over again, is she's not taking questions from the press. She's not sitting down for interviews. She's not doing these press conferences. But I struggle to think that that's going to be something that's going to be salient or resonate with voters going forward here after the performance last night.
David, great work yesterday evening, and thanks for this morning. David Gura there of Bloomberg. David calling it a missed opportunity. Big question about whether he'll get another opportunity to have a second debate. Equity futures right now a bit softer. We're down 0.25% on the S&P 500. Cameron Dawson of NewEdge Wealth with this to say. We expect volatility to continue through October as the normal seasonal headwinds in an election year are amplified by how stretched positioning, valuation and sentiment were going into this tougher seasonal stretch. Cameron's with us around the table. Cameron, good morning.
Good morning.
How do you process what happened last night and ultimately what it means for financial markets this morning?
I think we have to be careful about ascribing too much narrative in short-term price action to what's going on in politics. What we typically see is that markets are volatile during this lead up into election always, so regardless of Harris or Trump winning. And so as we move through this tougher seasonal stretch, we have to be appreciative of the fact that valuation, positioning, sentiment, expectations for growth were all extraordinarily stretched in July and August. So it just sets us up for this volatility.
That said, there was a narrative of the Trump trade earlier in the summer, and that was part of why we saw maybe such a boom in certain sectors of the market that people perceived as having a greater advantage. Is there such a thing as a Harris trade? Is there an analysis to be done in order to just have a scenario in place after the election?
This is where we rely on people like Dan Clifton at Strategist. He publishes these Harris versus Trump baskets, and they tend to be rather correlated with the odds of one or the other winning. And so what you have seen is that the Harris basket has moved higher in times when Harris's odds have gone up. So you could expect that to continue following this debate.
In the meantime, we're really focused on the economy. We want to understand what is actually going on. And I'm curious, from your vantage point, a lot of discussion about oil. What do you make of what we're seeing right now? Is this an economy that's falling off a cliff and oil sort of raising the red flag? Or is this oil prices allowing this economy to soft land more easily?
It is disconcerting, and it raises the questions about exporting of deflation from China, demand in China being weak. But if oil prices continue to fall, it does raise questions about U.S. demand overall as well. So we don't really want to see oil prices fall, but note, we don't want to see them rise. If you see oil prices rise, that's one of those exogenous inflation variables that could cause the Fed, or at least exacerbate the inflation story that does give the Fed less wiggle room. So oil being flat is the best case scenario. If it falls off a cliff, that raises bigger questions.
So what worries you more, oil falling more or potentially going high and having a shock, say something in the Middle East?
We do think that the downside risks for growth are higher than the upside risks for inflation, meaning that you're not seeing a lot of pricing power come out of companies. If you look at wage growth, there's really no signs that wage growth is picking up. Look at the quits rate. It typically is a good leader of wage growth, which just means that this is an economy that might be able to digest higher oil prices than the economy we had just a couple of years ago, which means that if growth is to weaken, it means that there are a lot of expectations that are too high, a lot of valuations that are too high, which would then be a source of volatility.
Some of the bank CEOs agree with you. Yeah. We're a month away from a big earnings season for the financials on Wall Street, and it's conference season right now. Dan Pinto, JPMorgan, analysts are too optimistic. Goldman's David Solomon, trading revenue on track to drop 10%. Ally Financial talking about pain in the auto loan book. What are the banks telling us at a time where we have investors on this program telling us to buy the financials?
I would be most concerned if JPMorgan or Goldman Sachs started talking about pain and credit issues within their corporate borrowers. We have been seeing pain within lower income borrowers, those that typically have bigger auto loans. We've seen that pain for quite some time. Delinquencies have been going through the roof, and that's notable given the fact that we still are in a relatively strong labor market. We're still seeing income growth. We are still seeing job additions. So to see that kind of delinquency rate, to hear what Ally is saying, suggests that the low-income consumer is really struggling in this environment. And you've heard that from corporates across the board, whether you're hearing from people like Walmart or some of the food service companies, which just says that this economy has two extraordinarily different cohorts. The difference is the low-income consumer makes up a much lower portion of spending, which means that they haven't drugged down the entire U.S. economy.
Would you be a buyer of some of the big banks on a sell-off yesterday? JP down yesterday by 5%, at one point down by more than 7%.
There's still an uptrend, and I think that that should be respected. We have to be very cautious, of course, in knowing that if you have areas of pockets of credit weakness, that could be an issue. But we continue to see people like JPMorgan being the crown jewel of the banking system to be the best in class, which just suggests that it can be a buyer on weakness.
Given all of this, and we just had the election and the bumpy road, you say, potentially in October, is there a place you can hide no matter what happens in Washington?
We would be cautious about chasing defensives too much. Things like utilities, staples, healthcare. You can choose names in that area, but be very valuation disciplined. Meaning, what you tend to see in the following the first cut is that utilities, staples, healthcare do outperform, but flows have started to get extreme. So our preferred way is to say that we like all sectors, but the highest quality portion of those sectors. Dividend-paying names with great dividend coverage, strong free cash flow generation, good balance sheets that can weather the storm regardless of what happens in Washington, and in some ways agnostic to what happens within the economy.
Cameron, appreciate it. It's good to see you. Thank you. Cameron Dawson there of NewEdge Wealth. Bramo, the bank's taken an absolute beating in yesterday's session.
I'm glad you mentioned Ally Financial. Not as big as Goldman Sachs, not as big as JPMorgan. This comment, our credit challenges have intensified. Our borrower is struggling with high inflation and cost of living, and now, more recently, a weakening employment picture. This is what is really pressing for both the Federal Reserve as well as investors trying to get their head around what that means.
It's not a pretty picture. That's for sure. Equity futures on the S&P then pulling back by a little more than 0.25% with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Secretary of State Antony Blinken has signaled the U.S. will consider Ukraine's use of Western long-range weapons against Russia. He also confirmed Moscow has received shipments of ballistic missiles from Iran, a deepening involvement by Tehran in the war. The U.S. currently opposes Ukraine using long-range weapons. Officials had cited concerns about escalation. Warren Buffett continues to sell shares of Bank of America. A regulatory filing shows Buffett's Berkshire Hathaway reaped $229 million over 3 days through yesterday. The average price fetched on Tuesday, $39.30 a share, was among the lowest reported since he began shrinking the stake. Berkshire still holds just over 11% of total shares. Taylor Swift has thrown her support behind Kamala Harris. The superstar announced her endorsement last night on Instagram, just minutes after the debate wrapped up. In the post, Swift called Harris a steady-handed, gifted leader and said she believes the country can accomplish more if led by calm and not chaos. She signed the endorsement, Taylor Swift, childless cat lady. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Equity futures pulling back just a touch by 1/3%. Up next on the programme, competing visions for the US economy.
Everybody knows what I'm going to do. Cut taxes very substantially and create a great economy like I did before.
Donald Trump's plan would make the economy worse. Mine would strengthen the economy.
We'll have that debate next on the programme, live from New York City this morning. Good morning. Equities this morning a little softer. Good morning to you. We're down 0.25%. Bit of underperformance on a small caps in the bond market. Getting used to this in the month of September. Bonds bid yield lower. 2 basis points on a 10-year, 361.98. Under surveillance this morning, competing visions for the US economy.
Everybody knows what I'm going to do. Cut taxes very substantially and create a great economy like I did before. Who's going to have higher prices is China and all of the countries that have been ripping us off for years.
The best economists in our country, if not the world, have reviewed our relative plans for the future of America. What Goldman Sachs has said is that Donald Trump's plan would make the economy worse. Mine would strengthen the economy.
Here's the latest this morning. Trump vowing to slash corporate taxes and impose a 60% tariff on China. Harris outlining what she calls an opportunity economy, boosting government spending and pledging to raise the corporate tax rate to 28%. Joining us now to discuss is a former US State Department chief economist, Heidi Crebo-Rediker, currently at International Capital Strategies. Heidi, welcome back to the programme. Going into this debate, you mentioned that this could be a major point of the campaign. Can you walk us through how major this might turn out to be?
So I think without overstating it, that this debate was probably the most important moment of this campaign so far. And I mean, just before I came on, you cited the Taylor Swift endorsement, which I have to say I thought was fantastic and could move the margins on people actually showing up to vote. But Kamala Harris had some real downside coming into this debate, and I think that she nailed it. She managed to get former President Trump to take the bait every single time. He was fired by 81 million people. The world leaders are laughing at him, talking about how U.S. military called him a disgrace. And so I'm happy to get into some of the issues about the economy, but I think a lot of this was about the presentation and the theatrics and how people sort of got the feel of a Kamala Harris versus a former President Trump.
Heidi, quickly on the politics, though, if you think she did so well, why is the campaign saying they should have a second debate?
So I'm not sure. I would say leave it where it is right now. I think maybe they wanted to make sure that she showed that she has game and she's ready to go at it again. But I think there's a potential for overconfidence here. This was a real win for her. She had him talking about people eating pets and killing babies. So I think she might want to leave it there.
Heidi, let's talk about some of the issues you mentioned. You've done a lot when it comes to economic state warcraft. Tariffs was on display yesterday. How does Kamala Harris go after Trump on tariffs, saying that they're a tax, when this administration that she's currently in kept Trump's tariffs from his prior administration on, and they are continuing right now?
So I think that the conversation during the debate actually got a little bit muddled on the, is it a tax or is it a tariff? The truth is that tariffs as a tool are here to stay. It's whether they are used strategically or whether they are used across the board. And so I think some of the things that I'm concerned about, I think people should generally be concerned about, is this 10 to 20% across the board tariff on all countries, which has huge implications for USMCA, various treaties that we already have in place, as well as foreign policy. If we're going to start slapping tariffs on your friends and allies in this kind of an environment, when you actually need friends and allies, that's a very bad place to be. When it comes to China, the use of tariffs, I think, particularly where it comes to steel and aluminum, when it comes to the overcapacity on EVs, those are areas where I think the Biden campaign is in pretty solid ground in implementing and keeping those tariffs on. So I think it's a matter of strategic versus not. And I don't think that people generally, the voters who were out there listening to this last night, understood that these tariffs would actually mean that they'd be paying a lot more when they go to get their retail goods. So I think that was not as well communicated as it could have been.
That said, Donald Trump did note that the Biden administration has left those tariffs on. They haven't removed them in their time in office. There wasn't really a response to that. And I wonder how much that's going to be a salient point going forward.
So I don't think that was the big message coming out of this debate. And I mean, this was not the debate was not meant for the vast majority of the population, and certainly not necessarily the business community. It was for a smaller group of voters that we all know and talk about and are targeting. And this issue, I don't think, is going to be front and center. The implications for inflation moving forward and whether goods will potentially increase in price as a result of new across-the-board tariffs, I think, really should be an issue. But I don't think I don't think it was really well explained. I don't think it's going to be a major issue for the rest of the campaign.
One thing that I do wonder about, we've been talking about on this show, is how the business community is listening to this and what the takeaway is at a time where it's policy light and a lot of it is about character. What do you think, given all of your experience in investment banking over many years, what do you think that people were listening to, and what did they hear about the prospect for business going forward?
So I think that the targeting of small business and the opportunity economy is actually, I think it's quite positive. You're going to have a lot of the business community looking at the fact that 2025 is a big year for tax, and whether or not we see the Trump tax cuts actually roll off or get renegotiated, and how. So that it's one way or the other, it's going to be a big year for tax. For people who are paying attention to whether corporates and billionaires are paying taxes or their fair share, or whether or not that's going to fall down to having working, ordinary, middle class people paying more tax. I think that's going to be a key differentiator. But again, I think that this is going to come down far more to tabletop issues, kitchen top issues, groceries, gas.
We'll come back to those issues in just a moment. Heidi, appreciate your time as always. Heidi Crebo-Rediker there of International Capital Strategies. The Vice President cited some research from Goldman Sachs. I'll share some of that research from Goldman Sachs in just a moment. Stay tuned for that. Up next on the programme, Gerard Cassidy of RBC as the big bank CEOs come out with a big reality check. That conversation just around the corner. Stock market a little softer. We're down 0.33% on the S&P 500. Some underperformance on the Russell. The small caps down by 0.55. I promised you an update from Goldman. So this is what the vice president said. Goldman Sachs has said that Donald Trump's plan would make the economy worse. Mine would strengthen the economy. Here are the two quotes from Goldman Sachs about a week ago. Goldman on Trump. We estimate that if Trump wins in a sweep or with divided government, the hit to growth from tariffs and tighter immigration policy would outweigh the positive fiscal impulse. On Harris, new spending and expanded middle-income tax credits would slightly more than offset lower investment due to higher corporate tax rates. That's the outlook for the economy. The outlook for earnings, Goldman, RBC, almost across the board. If you move the corporate tax rate from 21 to 28%, the outlook for earnings on the S&P 500 under Harris, not great.
Which is a reason why we have to do scenario analysis. What does it look like, depending on who wins, given how big the Trump trade was earlier this year? Isaac Boltanski put out this great chart, basically highlighting the probabilities, saying if you get a full Democratic sweep, if you get a full Republican sweep, and you get a lot of what you just hear about. You get a lot of tax cuts on the Trump side, and you get a lot of additional taxes and spending on the Harris side. And then you look at the likelihood, which is basically the same across the board because it's going to be split. And that, I think, is what a lot of people are banking on.
It's very, very difficult to process, but it sort of plays into the idea that maybe you get a bit of risk aversion going into the event itself. And that's what we've got on the screen at the moment. Let's turn to the bond market. 2-year, 10-year, 30-year. 2-year yields, lower the year. 2-year right now is down a basis point, 358. The 10-year at 362. 7 consecutive days of yields falling on a 10-year. On the 2-year, yesterday, yields dropping for a 5th day out of the last 6. You can make that 6 out of 7. The trend is absolutely clear. And I would go as far as saying this isn't just isolated to the United States. We have seen some big bids come in for a lot of supply on both sides of the Atlantic. We had an issue out of Italy in the last 24 hours with a record order book. Just last week, an issue out of the UK. More supply, gilt supply, record order book. We saw last week here in the United States, corporate debt in America, 2 very busy days, 2 of the busiest days we've ever seen in the corporate debt market. And we saw a lot of demand for that too. What is going on in fixed income?
People are basically giving up the idea that the new neutral rate is a lot higher. People are looking to rates being a lot lower. People are looking to the ECB, likely to even cut as much, if not more, than the Federal Reserve. And people are looking at the likelihood that there isn't a great alternative at a time where you do have this risk aversion to stocks. I will just say, though, today gets interesting because we get $39 billion of 10-year notes being auctioned at 1 p.m. And tomorrow we've got 30-year notes. It gets interesting the longer duration because we start to really challenge the idea of when the deficit matters and some of these other kind of fiscal aspects.
Things are getting interesting in the commodity market as well. Let's get you some scores. Brent and WTI. Brent falling into the 60s yesterday for the first time since 2021. Brent crude back in the 70s at 70.89. WTI 67.54. Things have become bearish really quickly. We've had price target cuts from Morgan Stanley and Goldman in the last week. Citi came out and said prices could average 60 in 2025, saying the market looks oversupplied unless OPEC Plus pulls back in a deeper fashion. $70 is the estimated long-run Shell break-even price. That's what the long-run break-even price is, and that's what people thought the floor might be for this sell-off in crude. We've gone above, or rather below, and beyond that situation.
So I keep going back to this question, and I think it's something that we have to keep asking. Are these declines in oil prices a feature or a bug of the soft landing? Because is this going to allow prices to continue to disinflate in a way that is very Fed-friendly, or does this indicate there is true weakness, that what we're seeing right now in terms of a weakening is something just that's a blip in this longer trajectory? And I do think that's really one of the anxieties that's underpinning this move, that's also going along with iron ore, that's also going along with other commodities like copper, and really does stem, yes, from China, but it has infected other areas as well.
I've noted a lot of analysts as well in the last couple of days just pointing out the difference between what's happening in the physical market and what's happening in the paper market, and we'll explore that theme a little bit later on this morning. Under surveillance this morning, a Bank of Japan board member signalling a rate hike is still in play, sending the yen to its highest level this year. The comments coming ahead of next week's BOJ meeting, where the central bank is widely expected to hold rates steady, but most people believe that at some point later this year, another hike is in play.
And I do wonder how much they've got an eye on the yen. They're not going to let this go, especially if the divergence can continue, even if they did get a revision downward to their GDP growth expectation. Basically, they're trying to signal, even if the data doesn't completely cooperate, we are in a new regime. Come on back. Not your tourists, but people who want to invest in Japan. And I wonder how much...
You're saying they don't want the tourists?
I think people have tourist fatigue. Did you see all of the proposals? Have you seen Greece, Santorini, and some of those pictures out of Santorini?
Yeah, they're done.
Yeah, so I think that this is also, it's not so bad. If
France has been done for a while. For like 20, 30,
exactly,
40,
I was about
50
to say.
Yeah, France has been done for a
3
while.
decades.
They've basically told everyone we don't want you there. I'm joking, kind of, not really. Dollar yen, 140 overnight, 140.71, just off lows of the session. We're at 141 at the moment. Elsewhere, Bloomberg, learning Nippon Steel has sent its vice president to Washington to boost its case for the takeover of US Steel. This coming as President Biden is set to block the merger deal as soon as recommendations from the Committee on Foreign Investment in the US lands on his desk. So here we are. We're in Philadelphia, Pennsylvania. We've got this situation playing out, and it's not a big feature of the debate last night. Why?
I was pretty shocked that they weren't asked head on about this, given the fact that this is Pennsylvania. This is steel workers in this state, and this is what everyone says the election's going to come down to. But reading the tea leaves, you can see what Nippon Steel is trying to do is they are trying to shore this up. Work that, honestly, if you see the correspondence of these emails that are coming out between the union and Nippon Steel that the Washington Post has gotten a hand of, this work should have been done months, if not years ago. But I'm still waiting on the timeline. When does that CFIUS review hit the president's desk? Is it going to be before or after the election? I imagine it's going to be before.
The fact that it wasn't part of the debate, though, doesn't that highlight that this really isn't the red meat that some people think it is? I mean, can you imagine, instead of abortion and immigration and pet discussions and other things like that, there would be like, Nippon Steel needs to do more to deal with the unions, and it gets complicated and hairy, and it has less of the messaging that some of these other sort of guttural issues have, which sort of speaks to whether that will actually be allowed after the election.
But it's tangible right now. This is a deal on the table right now, and they're both going after rank-and-file union voters. So I am a little surprised no one brought it up.
I think the absence of this conversation tells you more about the moderators than it does about the things that people in Pennsylvania actually care about. No?
Well, this is the accusation of the Wall Street Journal and of Fox News in their editorials, where basically they said Kamala Harris won and she was helped by the moderators. And that was the main argument there. Other people saying they were fact-checking. There is going to be a real question around what the role of a moderator is at a time when people play.
Been that question for a while.
I know. And what's the purpose of the debates? All these things.
Yeah, those questions will continue to be asked. Let's turn to the banks. A major feature of the sell-off for the financials yesterday. JPMorgan leading bank stocks lower after the company's president warned that earnings expectations are too optimistic. The comment sending shares falling the most in more than 4 years. This coming after US banks scored a big break from regulators on new capital rules. RBC's Gerard Cassidy joins us now for more. Gerard, welcome back to the programme, sir. I want to get straight into this. I believe, and I know you believe, there is a major difference between adjusting net interest income, that outlook based on changing your outlook for interest rates, and addressing and adjusting your outlook based on maybe deteriorating credit conditions. Did we get one and not the other from JPMorgan yesterday?
We did, John, and it's important to point out that JPMorgan Chase has been telling investors for over 18 months now that they are over-earning on net interest income because their balance sheet was asset sensitive, meaning as interest rates went higher, they earned more net interest income, which is a major revenue component for JPMorgan. They've been advising investors that if the Fed starts to cut interest rates, they will be negatively impacted, and that's what they pointed out yesterday. But to your point, John, they also say credit's holding in very well.
So, Gerard, let's explore one issue and then we can explore the other, the outlook for interest rates. Why did it take Dan Pinto coming out and telling people that low rates aren't going to be good for bank earnings for people to actually understand low rates won't be good for bank earnings?
They won't be good for his earnings because JPMorgan is asset sensitive. Not many banks are in the position that JPMorgan is. In fact, John, you might remember when they were raising rates in 2022 and 2023, Bank America was lagging because they had a very large portfolio of fixed rate bonds, and that was holding them back. So arguably, if rates are going to be coming down, Bank America now is going to benefit, or that bond portfolio will be less of a drag on revenue versus JPMorgan.
I do wonder, Gerard, if this is kind of the reverse of what we've seen, say, 3 years ago, where rates were going up and big banks didn't have to pass along that beta to their depositors. Now you have kind of the reverse of that, where people are saying, OK, we're going to put our money in money market funds, get some income. At the same time, that banks are actually earning less on longer term loans. How much is that kind of what we're going to see for the foreseeable future?
It's going to be interesting, Lisa, because initially what we're likely to see is when the Fed starts cutting rates, any loan or asset tied to SOFR, the Fed funds rate, essentially, that would come down in yield, of course. And deposit costs lag a bit, but deposit costs will be coming down if the Fed is going to be cutting rates, let's call it 100 to 150 basis points by the end of 2025. And what's happening and what should happen is that the asset yields, the cash flows coming from the bonds that were put on the books in 2020 and 2021 and fixed rate loans, they will roll over into higher yielding assets, because you recall where rates were back then. So you're actually going to see the margins improve for almost all the banks next year due to this dynamic of lower funding costs, and that will and the asset yields will benefit from rates, the cash coming off of the lower yielding earning assets.
I would argue that Dan Pinto of JPMorgan wasn't the main show yesterday. I would argue that it wasn't even Goldman Sachs and what they had to say. It was Ally Financial, which is much smaller, but came out with a real kind of worrisome prognostication about the consumer and how much they were falling in terms of their ability to repay loans. How much is that something that is Ally specific? And how much is that something that you're starting to hear around the margins at other large lending institutions?
It's a really good question because you get to the heart of the matter for banking. Credit is critical. And when you have credit deterioration, that leads to lower stock prices, as you saw with Ally yesterday. But it's interesting. They were an outlier. Let's go back to JPMorgan. They reiterated that their credit card delinquencies and charge-offs are not changing. And many other banks that have credit card portfolios have indicated that the credit losses are cresting and the delinquencies are starting to come down because the challenges have been with the lower FICO score borrowers. And so Ally, again, I think is an outlier. Investors need to watch it carefully. But so far, other banks have not given us any indication that the consumer is really going to be weaker. And yesterday's news, unfortunately, for Ally was a negative surprise. Absolutely.
Gerard, you gave us some clues about where maybe you think the road is going, what the future looks like. I want to talk about where we have been over the last 12 months. Some outperformance from JPMorgan, but only slight outperformance. The stock price up by something like 40%. Bank of America still higher by the high 37, 38%, something like that over the last 12 months. Gerard, are you suggesting that over the next 12 months we could see some real outperformance from banks like Bank of America versus, say, a JPMorgan?
John, I think you're right. I mean, JPMorgan's been a bellwether. It's been a fantastic stock to own, as you just pointed out, even though we did have the sell-off yesterday. But if the Fed really does move as aggressively as the futures market is calling for between now and the end of 25, JPMorgan could be the laggard because of the way their balance sheet is positioned. And these other banks could do quite well, like a Bank of America or even some of the regional banks such as PNC or Fifth Third. So I think what you're going to see, if the Fed does move on rates, that the banks that can lower their deposit costs quickly, and over time they will benefit on the margin. At the same time, credit remains resilient. That will be the key factor, credit, that you guys are talking about.
It's going to be a massive factor. Big theme for us in about a month when we do bank earnings. Gerard, looking forward to covering that with you. Gerard Cassidy there of RBC with a hint about where he thinks things are going over the next 12 months. Curious, given a certain Warren Buffett has been selling quite a lot of Bank of America stock over the last 12 months.
He hasn't talked about why. Some people have speculated it's because he wants to get ahead of capital gains taxes, which is also why he's been selling Apple shares. Nonetheless, he was one of the big stalwarts. He's been very quiet about it. And now I believe he now no longer owns more than 10% and doesn't have to report his real-time sales of the shares. So some really interesting machinations there.
Some interesting calls from Gerard as well. Equity futures on the S&P, negative 0.25%. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israel has proposed giving Hamas leader Yahya Sinwar safe passage out of Gaza in exchange for the group freeing hostages and giving up control of the Strip. Doubts have been deepening about the two sides' ability to reach a ceasefire. Israel has also said its military probably killed an American Turkish citizen by accident, prompting the U.S. to call on its close ally to make fundamental changes to how it operates in the West Bank. Apollo is working on its first ETF. It's teaming up with State Street on an offering that will include private credit investments. The ETF still needs regulatory approval. State Street joins firms such as BlackRock and Invesco in looking to make private assets more accessible to individual investors. Shares of GameStop tumbling the morning, 9.3% down in the pre-market trade. The video game retailer reported a fourth consecutive quarter of falling sales. It did, though, report an unexpected profit. GameStop shares continue to be buffeted, though, by the meme stock traders. In June, the company raised more than $2 billion after stock influencer Keith Gill, known as Roaring Kitty, returned to YouTube, inspiring a stock rally. The company has a market cap of about $10 billion. And that's your brief, John.
Danny, thank you. Stock influencers. Used to call them just outspoken hedge fund managers, didn't we? Weren't they always around?
They were, but they didn't really wear a tie around their head.
The attire's changed.
I am not a cat.
I'm not a cat.
Yeah.
Up next on the program, the final piece of the Fed's puzzle.
I'm in the base case that the economy's okay. I think they've got the room to do some front-loaded action. We've seen the real Fed funds rate creeping up. Let's get that back down again.
That CPI report just around the corner. That conversation coming up next from New York City. Good morning. Stocks down here, 0.25% on the S&P 500. Yields continue to fall across the curve on a 10-year, down a basis point or two, 362.54. Under surveillance this morning, the final piece of the Fed's puzzle.
I'm in the base case that the economy's okay. I think they've got the room to do some front-loaded action. We've seen the real Fed funds rate creeping up. Let's get that back down again. But then they will have time to sort of recalibrate in the new year, especially with new policy coming on board given the presidential election.
So here's the latest this morning. US Treasury's rallying ahead of the August CPI report dropping in less than 2 hours' time. It's the final big data point ahead of the Fed's next big decision. Michaud Darda with Roth saying this: the labour market is losing momentum, but the layoffs low and payroll growth still positive. There is likely no sense of urgency on the FOMC to front-load rate cuts on September 18th. Michael joins us now for more. Michael, I was reading your research, and welcome back, buddy. The final, or rather the first line, just read, analysts are basically too optimistic. And then you went through a range of economic data, and the one I picked out was new orders in the ISM. Can you just walk us through why new orders from the ISM is so important and what it tells you about how out of sync things might be with corporate earnings projections?
Absolutely. So, the new orders index for the coming out of the ISM has actually been a pretty phenomenal leading indicator for everything from forward earnings estimates for the S&P 500 to capital spending trends. It's just a cyclical proxy for demand. And yesterday we got data out of small businesses, the NFIB index, which actually showed the earnings diffusion index for small businesses really plunging in a quite startling way. So this is all taking shape against the backdrop of analysts expecting S&P 500 earnings to grow 14% over the next 12 months. I mean, that just seems awfully high. In a scenario where there is an unexpected recession, analyst estimates tend to be about 30% too high, and that just happens to be your average bear market. But even in a scenario where there's no downturn out there, the economy is decelerating. There is a real risk the Fed is falling behind the curve here. And look, we've got an inflation report coming up today. If inflation's moderating, where is the pricing power to deliver these high earnings expectations? Where is the top line growth coming from? I guess the response is it's simply fantasy land of sustained high productivity growth. And that's the bull case. And we'll see whether it comes to fruition.
Let's explore Fantasyland just a little bit more, Michael. There's a phrase that we've heard a million times on this program. It's different this time. The yield curve, the bull steepener, typically associated with an economic downturn. It's different this time. The move we've seen off the low on unemployment over the last 12 months, people are saying it's different this time. They're taking comfort from the supply side story. How misplaced do you think some of those conversations are, given what you've already told us this morning?
Yeah, John, no doubt. You hit all the important points. I think it's a risky story. And, the storyline is simply that Jobless claims are still low and job growth is still positive. So don't worry so much about these other forces and factors. In particular, this move up in the unemployment rate, 0.8 percentage point from the cyclical lows. That's something that's unprecedented outside of the economy moving into contraction. Now, it's always possible that it's different this time, but if the view is soft landing story intact, that backdrop has to make one increasingly nervous, or at least should make one nervous. On the productivity story, I think a lot of this relates to the upheaval associated with the pandemic. We had 8 quarters where productivity was negative between late 2020 and late 2022. At that time, nominal demand was booming by double digits. So if you have really strong demand and contracting supply, what happens to prices? They go straight up. As those distortions have unwound, we've actually got a nice pickup in productivity growth. So it's not totally fantasy land, but it's probably temporary. And I think what's happening here is some people are extrapolating this recent temporary recovery in productivity out way into the future based on a lot of AI hype. And if that proves to be a bit disappointing, then I think risk markets are going to stay choppy here.
I want to dig a little bit further into something that you mentioned earlier, saying that history shows that analysts' 12-month earnings forecasts tend to be about 30% too high at cycle peaks. You said that most bear markets are usually about a 30% drawdown. Putting aside recession or not, are you saying just based on profit estimates that you see a 30% downside risk in headline S&P indexes?
Yeah, I think there is significant downside risk here, recession or no recession. The S&P 500 is right around 21 times extremely optimistic forward earnings estimates. Even if those estimates end up not incredibly inaccurate, that kind of a multiple historically would be associated with exceptionally low 10-year forward returns, close to zero, even negative. And so from these levels, even in a good story for the business cycle, I think we have to expect much lower future returns. And unfortunately, what seems to be happening is investors are looking at the last 2 years of a straight up and to the right S&P 500 and just assuming that's going to go on forever. There's some pretty startling anecdotal information out there. You guys may have seen the recent Wall Street Journal story that was talking about how individual investors are super optimistic on stocks. They quoted a gentleman in his late 60s saying the conservative approach to markets is all in all the time. I mean, this is the stuff of market tops, not ongoing bull markets that are still intact. So it makes me a little bit nervous.
Isn't there a Fed put, though, Michael? Isn't the Fed going to cut rates dramatically and then everything will be fine?
There is a Fed put, but the question is, is that Fed put out of the money? And I think the risk here is that, yes, the Fed is going to be cutting, but if they're cutting and they're behind the curve, you can still have a business cycle downturn. You can still have profits that disappoint. And, John mentioned the belly of the yield curve disinverting just prior to the last 4 recessions and a lot of financial market upheaval going into those downturns. And, here we are again. So maybe it will be different this time. But the risk is the Fed cuts rates, but they're behind the curve. So they end up having to do more than is anticipated. The consensus view is we already have priced in a lot, but a lot would be a word you would use if you think the business cycle stays pretty steady here. In an actual downturn, then the Fed will be behind the curve and will have to cut more. One quick statistic, bond market inflation expectations have collapsed by 70 basis points since the spring. Yep. That means real policy rate, that would be like the Fed doing almost 3 25 basis point rate hikes at a time when the unemployment rate is moving up, payroll growth is slowing, economy is softening. So even a 50 basis point cut on 9/18, which is very uncertain, I actually don't think they're going to go for it. I think they're going to start with 25, would only partially reverse that passive tightening of monetary conditions. And that's the real risk set up here, I think.
Mike Darda of Roth. Mike, appreciate it, sir. Thank you. In the next hour of Bloomberg Surveillance, we'll catch up with Mike Wilson of Morgan Stanley, Rob Casey of Signum Global Advisors, Tom Michaud of KBW, and Stephen Schork of the Schork Group. From New York City this morning, good morning. Stocks pulling back just a touch. You're watching Bloomberg TV.
We're seeing an elevated wage growth, but not wage growth that's going to trigger another bout of inflation.
There's a lot of reasons to think that inflation could be stickier, and the Fed is really focused on that.
The next few months, inflation, the pace and path of inflation is going to get a little more difficult.
It's underappreciating the level to which we're all going to have to live with structurally higher inflation.
I don't think the inflation boogeyman's totally gone. I think it's just under the bed for a little while.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
If inflation's the boogeyman, no one's talking about it this morning. The print drops in 90 minutes' time. CPI is just around the corner. Equity futures this morning, and good morning to you, pulling back by 0.25% on the S&P 500. Just a little bit of underperformance on the small caps. The Russell is down by 1/3%, but recovering slowly. If we take a look at the bond market, I think that's where the headlines have been. We continue to fall. Yields lower by a basis point on a 2-year. Lisa down a basis point as well on 10s over the previous 7 sessions. 7 consecutive sessions now. Yields are falling on a 10-year maturity.
And this is partly due to certainly what the Fed is going to do, but also due to the fact that no one is talking about that boogeyman that was a boogeyman, say, 9 months ago, which was inflation. And now you're seeing inflation expectations over the next 5 and 10 years really fall off a cliff. Key question, Edgar Dunny hinted at this. If we get confirmation of this at 8:30 a.m. in 90 minutes' time, is there a sense that there is a weakness that is driving this, that it's not immaculate in the same kind of way that it used to be? Or is this being driven by something that still is a wonderful nirvana that can support everything?
The commentary from Ally Financial speaks to the weakness. The move in crude last week and again in the last 24 hours potentially speaks to weakness. Now, later this hour, we'll explore the difference between what's happening in the physical market in oil and what's happening in the paper market. The fear in the paper market about an economic downturn building big time in the last week.
And not being ratified in reality. And that's what we're seeing around the margins with a lot of the surveys, at least not yet. That said, that is the fear that is percolating out right now, this idea that maybe you're seeing something different. And it's not just in oil. And we talked about this before. It's also in iron ore. It's also in copper. You're seeing this pretty broadly. To me, there is a bigger fear, especially when Ally Financial calls out an increasingly tenuous labor market picture to really highlight why they're seeing consumers not paying their bills on time as much.
We are coming into Wednesday, coming off the back of a big debate in Philadelphia, Pennsylvania between Harris and Trump. A lot of people describing it as a missed opportunity for the former president, and an outstanding question still. Will it be the only opportunity that he gets to have a debate this cycle?
Well, we're still waiting to know whether or not he would agree to a second debate. Kamala Harris came out, her campaign said they're happy to have another one, so potentially in October we would see one. But Jonathan, you nailed it. It was a missed opportunity for the former president because Kamala Harris made him the incumbent. His best line to use against a sitting vice president to try to tether her to Biden, which many people want to move away from when you look at the polling, came his last sentence in the entire debate. You had 3.5 years, everything you're talking about, why didn't you do it?
Now the question is, how much will this debate matter? How much will this really turn the needle? And for market participants, at what point is there a trade on the heels of this at a time when we're staring into the sun, staring into an abyss, trying to figure out something that's in a crystal ball that nobody has? Pick your poison.
Yeah, good luck. Right, basically for investors over the next 2 months or so. Snapshot of the price action for you, then cross-asset, talked a little bit about the stocks and a little bit about bonds. Let's sit on crude just a little bit more. 67.19. It's a rebound, it's a bounce, but it's been a big move lower in the past week. We're up by 2 percentage points on WTI. If you look at the FX market, the dollar a touch weaker, euro stronger, 110.51 on that currency pair. Coming up on this program, we'll catch up with Mike Wilson of Morgan Stanley ahead of key inflation data. Rob Casey of Signum Global Advisors following last night's showdown between Harris and Trump. And we'll speak to Tom Michaud of KBW on the bull versus bear case for financials. We begin with our top story. Traders are waiting CPI at 8:30 Eastern time for clues about how much the Fed will cut rates this time next week. Concerns are lingering over whether the central bank has waited too long. Mike Wilson of Morgan Stanley writing, until the bond market starts to believe the Fed is no longer behind the curve, growth data reverses course and improves materially, or additional policy stimulus is introduced, it will be difficult for equity markets to trade with a more risk-on tone. Mike is with us around the table. Mike, good morning to you, sir.
Good morning. How are you?
I want to pick up on that quote, and we're doing great. I want to pick up on a line that you're focused on. The difference between Fed funds and the front end of the yield curve, Fed funds in a 2-year, and that quote, how important is that?
Well, that's a signal that we're getting from the bond market. The bond market has historically been a pretty good indicator of where the Fed is relative to kind of what they need to be doing. And we saw this, by the way, on the upside too, right? In the 2021 timeframe, the 2-year got ahead on the upside. So it's the same picture just on the other side. And you know, people complain, oh, they don't complain. They say, well, look, the stock market is behaving fine. But that's not true. Internally, once again, you know, defensive stocks are really doing extremely well. So I think the stock market is taking its cues from what the bond market is saying. It's not saying hard landing yet. What it's saying is that growth has continued to disappoint. So since April, and we've been on this program many times since then, I would say that the data has been distinguishedly negative in terms of growth data. Also, the labor data has been much worse. So how has the equity market dealt with that? Well, it's pivoted from what I call quality growth to quality defensives. And we made that pivot in May, and that's classic late cycle behavior. So I think everything kind of sinks. It's just we're waiting for the, you know, like, can somebody give us the keys to the test? You know, the cliff notes, whatever it is. Like, how's this going to end? And we don't know.
But the market's, don't you? I'm going to ask you. Basically, you've said we need one of two things. Either the Fed cuts aggressively or the labour market starts to improve and improve quickly.
That's right.
For equity markets to perform well. So have you got a base case? Is it one or the other? Do we get one or the other?
Well, what I would say is that the Fed could get ahead of the curve if they decide, but the problem, they're constrained. Okay, they're constrained by two things. Not inflation, by the way. Inflation's over, as far as I'm concerned. Inflation, they beat that. What the issue is now is the currency market. If they come in and start cutting aggressively, the yen-dollar relationship is going to create some stress. So they got to be careful with that. The other thing I would throw out there is that we've looked at this. When the Fed starts a cutting cycle with 50 basis points, as opposed to 25, the chance of a soft landing goes down materially. And they know this. They know this data. They don't want to signal that. So they're in a tough spot. The Fed's in a difficult spot. They've done a good job of trying to navigate this, you know, challenging, different environment that we've been in for the last several years. But now the markets are pressing them. And so next week, I don't really care what they do next week. What I care about is how the markets react. How do the markets behave after they've done what they're going to do, 25 probably, and then what do they say in the press conference?
The vibes, whether they actually work for the market or
That's
not.
Right.
I'm curious, though, before we go into quality growth and quality defensive and what that actually means, you said something about the currency differential. Are there certain target levels that you see sort of unwinding some of the longs that still remain out there? Do you have a sense of just how disruptive the ongoing long trade for the dollar really will be potentially down the road?
Yeah, I mean, I don't have a specific level, but I do feel like they're trying to defend this low 140s level between yen dollar, so call it 142. If we start to, 130-ish, 138, 139, I think that could cause some stress in other markets.
Meanwhile, you talk about shifting from quality growth to quality defensive. I've struggled with these monikers quite a bit, simply because what does defensive, what does growth mean? Where does NVIDIA fit into this? Or does the tech trade go, given the fact that people have gotten an AI trade that is so inflated in terms of expectations and timing? What does that mean to you, quality defensive?
Defensives are your classic defensive sectors, whether it's utilities, staples, healthcare, things that are positively correlated to bonds. Okay, they did not trade well, by the way, up until sort of April. It was really the quality growth stocks. Now, the other thing that's happened is the AI dream has taken, a little bit of that luster has come off. And I really gauge that by what semiconductors are doing. It's not just NVIDIA, it's semiconductors writ large. And a lot of those stocks have really come off. And that makes sense to me. We just got overcooked on the whole AI theme. It doesn't mean it's over. We've written about this extensively. Like, we're not believers that this is going to change productivity materially in the short term. That's a long-term story. And everything kind of got bid up on that. So with that theme now gone, the market is looking for a new theme. On the growth side, there isn't one. So what it does is it hunkers down into defensive, high-quality assets until we get the next thing. Whether that's a bad outcome or a positive outcome, they're going to hide out in these areas.
Mike, you say inflation's over. We do have CPI data, though, today. So I'm curious to know, how do you think the market would trade if we get, say, a hotter print? Say, is it too volatile? Or softer print? Would the market start pricing in 50? Or look at a softer print and say, wow, we are cooling down faster than even the Fed was expecting, and bad news really is bad news?
Yeah, well, when I said inflation is over, I mean the rate of change on inflation is over, and it's kind of over for equity markets, and quite frankly, it's over for the Fed. Where inflation is not over is the price level. Right? The price level is absolutely squeezing the heck out of businesses and consumers, and so it's like a vice. And so I don't think inflation is over in that regard. But what I would say is that a hot number, I think is probably pretty bad for the stock market today. I'm not expecting that, but if we got a hot number today, then all of a sudden the Fed is going to stay behind the curve. They're kind of stuck. If we get a really soft number, then we go back to our old thesis, which is pricing power is gone. Okay, so we kind of need to thread the needle here a little bit too. I mean, break evens are at 2% now. So what are we talking about? We're already at 2%, and it's not like these things stop on a dime. They have there's a risk that we undershoot on the downside. That's good for bonds and is bad for stocks typically. And by the way, that's how the stock market, that's how the markets are trading. So I think the markets already understand all of this. Once again, they're going to do something next week to try and manage the situation. 25 is what we think, and they'll signal for more 25s, not 50s. And then what do they do with the balance sheet? I think that's probably the bigger wild card. Do they talk more aggressively about ending QT more quickly? Do they find other provisions to provide liquidity? That's the bull case in my view. That's where we could be surprised on the upside. Is there more liquidity coming into the system from other sources?
And after next week, then everyone's going to really be focused on the U.S. election. Goldman Sachs, RBC, they talk about how earnings will be much higher potentially under Trump administration if he gets his tax cut plan, rather than Harris, who's calling for 28%. How do you view next year earnings growth based on these two proposals?
Assuming that the economy is in a soft landing, okay, that the Fed hasn't overstayed its welcome, and by the way, I think that risk is still on the table. We're in the soft landing camp, but that to me is way more important than the outcome of this election in the next 6 to 12 months. So let's assume we're in a soft landing. Our view is the same. We think that basically Trump is kind of pro-growth, kind of bad for bonds, good for stocks, okay? And that's how we would look at it. And by the way, last night when the debate was going on, the betting markets kind of went in favor of Harris, and the stock market futures kind of traded a little bit, okay? But I do think the stock market is more pro-Trump. I mean, the stock market has traded better when his odds go up and vice versa.
So bonds are good under Harris and stocks are bad under Harris?
In theory. I mean, at the margin, I would say that's the setup. And the reason being is really taxes. Taxes is the one thing, and that requires some congressional support too. But to me, that's the big issue, not tariffs so much. Both administrations have tariffed. And then immigration, I think both parties are going to have to deal with that in some way. So taxes is the issue. Obviously, Trump is talking about cutting. Harris is talking about raising them. That's bad for stocks, good for bonds.
Wanted to ask you this question. I want to squeeze it in at the very end. Lisa was knocking on the door. Are utilities actually defensive? They're up like 20% this year, and it feels like everyone's getting whatever they want from utilities. It's defensive. It's attached to AI. What are utilities?
So this is a very interesting question. So, we agree. I mean, we don't think we were one of the first ones to talk about utilities as an AI beneficiary back in February, March. I think that's probably gotten a little overdone, to be honest. But now utilities are definitely trading with the bond market. So the defensive properties of utilities are, I think, dominating their performance in the near term. Here's the interesting thing about utilities. Their balance sheets are not great. Okay, so you got to be really careful with utilities. If it's going to be a hard landing, these things are going to start trading really poorly. So I would caution listeners, if utilities start trading really poorly and the stock market's not ripping, that's a bad sign. That would be a sign that, we are actually getting closer to potentially hard landing risks. That hasn't happened yet. But if you look at things like low volatility parts of the stock market or defensive, they've gone almost parabolic. And if they start to sell off hard without a stock market rally, then I get concerned about hard landing risk. That's not the case today.
Interesting. Mike, this was great. Clinic as always. Thank you, sir. Mike Wilson there of Morgan Stanley. Equities recovered just a touch. We're down 0.25% on the S&P with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. People familiar say Nippon Steel sent a senior executive to Washington to boost its case for the $14 billion takeover of U.S. Steel. President Joe Biden is set to block the merger. Kamala Harris and Donald Trump have also criticized the deal. Hurricane Francine gained strength and caused some offshore oil platforms in the Gulf of Mexico to be shuttered. It was expected to make landfall in Louisiana today, but it will likely miss the major nat gas export plants. The U.S. Weather Prediction Center said storm surges in some coastal areas could reach 10 feet. After making landfall, the system is forecast to move across Mississippi on Thursday. And LVMH is in late-stage talks to become a major Formula One sponsor. People familiar said brands like Tag Heuer and possibly Moet Champagne and its hotel chains may see their logos and products prominently displayed to race viewers. The potential agreement could be worth a reported $150 million annually. It is a blow to Rolex, which has been the official timekeeper of F1 since 2013. And that's your brief, John.
Danny, thank you. I spent the last year on this program trying to sell AC Milan to the Arnault family.
Yeah.
Not sure if anyone's listening. Now they're getting into
Really?
Formula One.
You want them to either sponsor it or do you want them to own it?
No, I want them to own it.
Yeah.
I'm not sure what AC Milan think about that. Speaking for myself here, but I'd love them to own it.
They'd have beautiful uniforms.
Deep pockets, beautiful uniforms.
Yeah.
Everyone wins. Everyone wins.
Keep going.
Up next on this program, trading blows on the debate stage.
The American people want a president who understands the importance of bringing us together.
She's going to do this, she's going to do that, she's going to do all these wonderful things. Why hasn't she done it?
And why did he wait so long to say it? That conversation up next from New York City. Good morning. One thing that is not getting much coverage at all this morning, a CPI report that drops in 1 hour and about 12 minutes time. If you go back 6 months, maybe even 4 months, it would be the only thing we're talking about this morning, and it's not. It just feels like a lot of people, feels like the central bank has moved on, and maybe for good reason. We'll find out at 8:30 Eastern Time. Equity futures right now on the S&P 500 a little bit softer. We're lower by 0.25%. Yields down a basis point. The 10-year 362.54. Under surveillance this morning, trading blows on the debate stage.
The American people want a president who understands the importance of bringing us together.
She's a Marxist. Everybody knows she's a Marxist.
Donald Trump certainly should not be telling a woman what to do with her body.
I'm not in favor of abortion ban, but it doesn't matter because this issue has now been taken over by the states.
People start leaving his rallies early out of exhaustion and boredom.
She's going to do this, she's going to do that, she's going to do all these wonderful things. Why hasn't she done it?
Here's the latest. Kamala Harris challenging Donald Trump to a second debate with under 8 weeks remaining until Election Day. Trump saying on Fox News earlier he is less inclined to debate Harris once again. Rob Casey of Signum Global writing this. Harris had a very good night. She did not land any knockout punches. This is going to be a close race tomorrow as it is today. But Harris carried herself with great composure and successfully defined a stark comparison between her policies and those of Trump. Rob's with us around the table. Rob, good morning to you, sir.
Morning.
You said she had the edge going into this. Your base case is that Harris wins this election. Did anything change overnight?
You know, I don't think a lot changed. I think Harris had a good night, but how voters feel about Kamala Harris and how voters feel about Donald Trump, I think yesterday into today, not a whole lot different. You know, Harris did introduce herself to more voters, voters who maybe didn't know much about her as she was a senator and VP, maybe didn't turn into the Democratic National Convention. So I think in that sense, you know, Harris proved once again she can be on that stage. She deserves to be on that stage, even though she didn't win any primary votes. But that being said, this was not a debate to change people's minds.
There's a phrase that you've used, you and the team in your research, asymmetric incumbency. You get to fly on Air Force Two, but without the baggage. Now, the former president seems to be doing a pretty poor job of prosecuting the case and getting people to realise that there is some baggage here. Where is he falling short on that front?
I think it's a much easier argument to make against Joe Biden than it is against Kamala Harris. You know, I think most of us in the country understand that the vice president doesn't have a whole lot of power. Was she tasked with the border? To a certain extent, yes. Do I think that that's a very successful attack line against Kamala Harris? Yes, and it's one that Trump made last night. But that being said, you know, she's essentially an undefined quantity. She's done a better job of defining herself than Trump has of defining her.
Some individuals are going to start voting next week, especially in a swing state like Pennsylvania. Trump's saying he's less inclined to debate Harris again this morning on Fox. Kamala Harris's team came out right away and said, we want a second debate. What benefits her of having a second debate if you and many others would say, and the predict market has her up now saying she won this one?
You know, I think that was a stellar decision by the Harris campaign to come out and say immediately after that she's ready to go again, right? She won. She wants to do it again. She doesn't think it was a fluke. She's happy to step on any stage, anytime. That being said, you know, I don't think Trump is eager to get back on a stage. And there's a lot of back and forth about the rules and anchors and moderators, and last night maybe fairly so. So I think it'll be hard for the two campaigns to come to an agreement about a second debate. That being said, I think brilliant move by the Harris campaign to say that she's ready to go again.
I know this wasn't actually in the debate, but Taylor Swift did come out after and endorse Kamala Harris. And the reason why I'm interested about this is because Evan Roth-Smith yesterday said they're going after last night 500,000 people. Does Taylor Swift actually move the margins into Harris' camp?
I think she moves the margins marginally. I mean, I don't think it's a huge change to the race. I think it's the single most important celebrity endorsement in this campaign, certainly, maybe in U.S. presidential history. And that's because, the Taylor Swift base, if you want to call it, is largely white, suburban women, often young women. These are the voters who could decide the election. They're certainly voters motivated by abortion, among other issues. And so for Taylor Swift to come out very explicitly last night following the debate in support of Vice President Harris, I think it can only help her, although maybe not that much.
Just to build on something that both Emery and John were talking about, how much at this point can the only thing that really changes the tune of this election come to turnout? Essentially, this is just a turnout game more than anything else.
Yeah, it really is. And between now and November, and we talked about this last week, there aren't a whole lot of things that are likely to change the election a whole lot, right? We talk about October surprises all the time. The data doesn't really show that October surprises change voters' minds a whole lot. So between now and November, I think the question is, can Kamala Harris sustain her momentum? Out of the convention, she didn't get the bump that I think she and Democrats would have liked. In the past week, she's seen some polls that are not quite as positive as in the past month. But coming out of the debate, and sort of this is really the sprint to the finish, the question is, can she sustain the momentum necessary to turn out Democrats across the country? Of course, she's helped by issues like abortion, among others, that are explicitly on the ballot. As long as she doesn't, stub her toe, I think the momentum is such that turnout will benefit Harris in November.
From Market's perspective, it seems like a lot of people are discounting the election to a large degree, partly because there is no visibility, but also partly because there is an assumption that there will be divided government and that nobody will actually get their agenda fully through. What gives you confidence that that's going to be the case at a time where potentially, if it comes down to turnout, then more turnout for one candidate could mean more down ballot races that people win as well?
Yeah, absolutely. And I think that, a blue wave under a Harris campaign is more likely than it was under a Biden campaign because Biden proved to be such a drag on Senate and House races for Democrats. That being said, the Senate map essentially comes down to a few particular states that Trump is going to win by 30, 35 points. I mean, I'm talking about Montana in particular. If John Tester can't win that seat, of course, assuming that Republicans take West Virginia following Joe Manchin's departure, that leads us to a 50-50 or a 51-49 Senate in favor of Republicans. Of course, that's a divided government necessarily. So I think it's really the Senate map, as good as Democrats feel about the presidency, as good as they feel about the House, and they feel very, very good about the House, it's the Senate math that is not in Democrats' favor. And I think Republicans are probably able to flip Montana, if not one or two other states.
I know this is scenario analysis with various probabilities attached to it, and we can sit here and say it is a low probability outcome. But if we got a blue sweep, wouldn't that be absolutely terrible for equities in America?
Yeah, I mean, point blank, yes, I do think it would be a problem. There are not the moderating forces in Congress that there were under the first 2 years of the Biden presidency, which was, as we all remember, a blue wave, but a blue wave tempered by Joe Manchin and Kyrsten Sinema. And there would not be those voices in a new Congress under Harris. I mean, as we've all seen, the Wharton budget model suggests that, Harris's policies writ large, were they all to pass, would not be quite as deficit negative as Trump's across the board. But that being said, a blue wave without kind of the blue dog, very, very moderate senators who are willing to stand up against the party, I do think that would be negative for equities overall.
Interesting. Rob, thank you, sir. Rob Casey of Signum Global Advisors. Mike Wilson of Morgan Stanley on the program 15 minutes ago and saying red wave ultimately good for stocks, bad for bonds. If you get a blue wave, bad for stocks and good for bonds.
Essentially, more focus on revenue raising, focusing more on the taxes than maybe the levies or the tariffs that you see coming out of both camp. Again, how much can people take this seriously before you really see the whites of the eyes of one of these outcomes that seems like less than a 50% probability?
With great difficulty, especially given experience. I think we all remember that morning in November 2016.
Yes.
When it was like sell Trump, and then quickly buy, and then we didn't look back.
Right, so that's the reason why none of us want to try to sound smart ahead of that, because we will not be.
I don't think anyone can sound smart in this situation. Up next on this program, we'll catch up with this guy, Tom Michaud of KBW, following a big sell-off in big banks. From New York, this is Bloomberg. equity futures right now in the S&P 500. Just a little bit softer. We're down 0.25%. On the Nasdaq at the moment, down 0.33% on a Russell, down 0.25%. Yesterday on the S&P 500, actually posted a 2-day winning streak on the S&P for the first time since August 19th. Beneath the surface, though, and this is what Mike Wilson and Morgan Stanley was talking about. Look at energy, look at financials. They got absolutely hammered. So let's start with the financials. Switch up the board and get to the bond market. The 2-year, 10-year and 30-year. The 2-year yield is down again by a basis point. The 10-year yield is down for a 7th consecutive session. There has not been a single day this month where the 10-year yield has actually finished the day higher. We're down to 362.17. JPMorgan came out yesterday and basically said the problem was interest rates. Ally Financial came out and said the problem was credit. Which one it is going to be really important to how this equity market trades over the next 12 months.
If it's interest rates, oh, poor JPMorgan, if they earn $85 billion rather than $90 billion, everyone's going to cry. No one's really going to think that's a bigger story. If it is a credit quality story akin to what Ally was talking about, that speaks to the soft landing versus hard landing and has a very different and more pernicious implication for the rest of the market.
That's the bond market. We'll come back to the financials in just a moment. I mentioned energy trading really poorly yesterday off the back of the commodity itself and a big downdraft over the last week or so. Crude is bouncing this morning, up 2% on both Brent and WTI. Brent trading in the 60s for the first time since 2021. In yesterday's session, we traded 70.68 this morning. On WTI, it's 67.33. AMH, you were going through some of the commentary from some of the trading houses, the big oil players. Gunvor in the last week. The chairman, just yesterday, I think. Today, we're producing much more oil than we're consuming, and that balance is seen to worsen over the next few years. And I think that speaks to the divide emerging between how poorly the paper market is trading versus what's happening in the physical market right now.
Yeah, and I think we need to remember where we are in the calendar. We're in September, going into the fall, going into the winter. We are past peak driving season. At the same time, you have traders really concerned about China. We've seen this before with China, and you've mentioned a lot, Lisa, today, across the commodity space. This would percolate when bad data would come out of China. But now the concern is the landing in the United States and some of the dour economic data we are seeing stateside.
On the oil market, Stephen Schork of the Schork Report joining us in 20 minutes' time. Look out for that conversation. Under surveillance this morning, traders awaiting US CPI due out in less than 1 hour's time. A Bloomberg survey calling for another month of muted increases, with core CPI rising 0.2% in August, following similar advances in July. And dare I say, no one's talking about it for good reason, because it's been so subdued compared to where we were in the last few months.
Mike Wilson said it's over, basically, not in terms of where prices are, but in terms of the rate of change. And certainly the Fed seems to think that. And certainly when you look at Fed funds futures, as well as break-even rates, you're seeing that also fall to some of the lowest levels going back to 2021. Key question to me, and we've asked this before, at what point does a downside surprise actually have a bigger implication for markets, just because it is on the heels maybe of something that isn't just year-over-year comps, but something that is a little bit more deep and speaks to weakness that we're hearing about from the likes of Ally Financial?
Things are very finely balanced at the Federal Reserve. Granted, what is the difference between 25 and 50, and does this close the gap for the debate a week away today?
And is a 50 basis point rate cut perceived negatively by markets? I mean, that's a big question. Mike Wilson also talking about how his big question is not whether they cut 25 or 50. It's what's the response in markets, because does that indicate that people see this as getting ahead of the problem or catching up to a problem that was bigger than they previously thought?
Special coverage next Wednesday on that Federal Reserve decision, that CPI report dropping in just under an hour's time. Let's turn to this story. US Secretary of State Antony Blinken set to travel to Kyiv today. The visit coming after he said Russia had received shipments of ballistic missiles from Iran to help its war in Ukraine, adding that the Biden administration was imposing more sanctions against Tehran. Are those sanctions working?
Well, no, and I don't think these sanctions, whether some of them are about asset freezes or also restrictions on the national carrier, are really going to change whether or not Iran is going to provide Russia with this lethal weapon. What is interesting is the timing of this visit, given the fact that for months Ukraine has been asking the United States to lift this barrier, to go after jets basically parked in Russia. I mean, I've spent some time in Ukraine this summer. That is something they've been asking for. And maybe now with Iran sending these ballistic missiles to Russia, they're finally going to loosen it up.
It's an alliance they've been unable to break, and arguably an alliance that's strengthened in the last 12 months.
Which is the reason why you do wonder why people are looking for another boogeyman other than inflation. Well, here's something else that's sort of very much on the front burner that people are looking at to potentially be the unseen catalyst.
That's the latest in the Middle East. Let's turn to a far more important story here in America for today. US leaders heading to New York City for today's 9/11 Commemoration ceremony. Tom Michaud, the CEO of KBW, a Stiefel company, is a board member of 9/11 Day, a non-profit organisation dedicated to turning September 11th into a national day of service and remembrance. Tom joins us around the table. Tom, good morning. It's good to see you.
Good morning. Good to be with you as well.
KBW headquartered at the World Trade Center all those years ago. You lost your co-CEO, most of the front office. It's a big rebuild over the last 23 years. Just spend a moment talking to us about that.
Well, there's no chapter in a business school book about what to do when that happens. It really comes down to your core values, the culture of the firm, to be able to push the rock up the hill a little bit more every day, which is what I think we did. And it was we. It wasn't me. It was we. And then the other thing is you often have to understand the spirit that's around you, which is will tie into 9/11 Day, which is the goodwill and the energy of resilience was enormous. And frankly, you know, we had a key meeting in the days after 9/11 where we said the firm was not going to end this way. And we were going to do two things. We were going to do everything we could to support the families of 9/11, and we were also going to rebuild the firm. And by rebuilding the firm, we were going to be able to help the families more, and we were going to collectively be able to do it together. And look, at the time, you know, we had 224 employees. We're not a big company. But we were able to pull it together because of that community. And I think really, you know, it's a big part of our culture, which still remains today.
I've been lucky to get to know you well enough over the last decade or so. When you say rebuild the firm, I sense that job isn't finished for you. Can you talk to me about that and how the work of 9/11 Day plays into the overall picture, the overall effort for you and the team?
Sure. You know, the first thing is the story of 9/11 is not over. You know, we just keep turning the pages and keep writing this story. And one of the things is we all said we were never going to forget, but I think everybody's definition of never forget is different. And so now that we've had 23 years and you look back and say, what does never forget mean? Well, never forget means certainly you always want to think about those who were killed that day. More importantly, what their families have done to carry on is remarkable. And then there are a bunch of organizations that I think are doing really good work. We helped stand up 9/11 Day. 9/11 Day convinced Congress to make 9/11 a national day of service. We now believe it is the largest day of service in America. Today, in 21 American cities, with 30,000 volunteers, 500 corporate sponsors, we're going to pack 9 million meals for those who are food insecure. We've teamed up with food banks around America. We are growing at a double-digit rate every year. And what it is it's a chance to honor those who were killed by remembering the goodwill and the resilience. And so this is a step forward, because what I know I personally don't want to have happen is to be 9/11, 2 paragraphs in a history book one day. Over a third of America is too young to remember. And as someone who was standing on the sidewalk that day, watched what happened and then watched the aftermath and was on the phone with some of these spouses who called and said, have you seen my husband or my wife today? That is something I will never forget. And it's something that we have to remember as a nation as we move forward and deal with some big challenges.
And the missing posters and all of the quietness in the city, I think a lot of people think it was a lot less than 23 years ago who were there in terms of its poignancies and tragedy. I'm wondering, from your perspective, how you feel like it transformed the New York City Wall Street environment in a more significant way, because it really was a sort of seismic break in a trajectory that had been going in one way and then took another turn.
Yeah, so first of all, I'll tell you, both the New York and the NASDAQ stock exchanges are going to recognize 9/11 on their openings today, which I know the community is very grateful for, because this happened in the heart of the financial system. You know, the stock market didn't open for a week. We had to put our books and records back together again over that week to just understand where we stood. And communication lines were severed. And what it took to get the markets, the economy, the financial system, and also to start the healing process was quite remarkable. And it just goes to show you how the collective community can rebound when needed. And we got to remember that a little bit more. You know, the nation's divided on many topics, 50-50. Yep. So we need to remember that moment a little bit, because there is no color identification of affiliation. This was one group coming together to do the right thing.
We should all be united on that. You mentioned the moments of silence. We will be respecting them here at Bloomberg, the first of which is in about an hour from now. So we will be doing that in about 60 minutes on this programme. It's fantastic to see the rebuild effort continue, to see your firm thrive. There were moments on that day in the aftermath for weeks, months, even years, where there were doubts about the future of the financial centre here in New York City. So to see you all come together this week, I think is really important. Dominating the headlines of the last 24 hours, as you know. It's conference season, everyone coming together for the Barclays Global Financial Services Conference. I want to delicately move towards that subject.
Sure.
What was your takeaway from this week? What was it like?
So we are balanced. Our just to get to the conclusion, our firm is market perform on the banks. We're not buy, we're not sell. There are powerful forces moving in each direction. So the powerful bullish case is that revenues inflected in the second quarter for net interest income. Taking some of the heat off this inverted yield curve with Fed policy is a good thing. Revenues for the typical bank are going to start growing. On the opposite, and I would say the majority of the banks at the conference this week reiterated their net interest income guidance. With regards to credit, though, that is always the biggest boogeyman in the closet. Credit can affect earnings very quickly. And so we had Ally Financial, which was down 17% yesterday, start to talk about consumer loss patterns being worse than expected. And we've heard it from some of the others. And so this now is going to possibly put the market in wait and see mode on soft landing versus hard landing. And that has a big impact on the banks. So that is a factor as well. So that's why, as a group, we think you could still continue to see some negative headlines. Now, we've picked out some. That doesn't mean we don't like any stocks in the group. There are plenty of. We've shifted from banks that would do a little better in higher rates to banks that will do better in lower rates. We upgraded a stock called Comerica this week, which we think will probably grow earnings by 50%, earnings per share in the next 3 years. So we've identified those companies. The other theme this morning is there's a big bank merger potentially being talked about in Europe, with UniCredit owning 9% of Commerzbank. So there's this big battleground happening with banks and non-banks, and scale is a required necessity, I believe, to allow banks to compete with non-banks. And you're seeing the consolidation wave continue at the same time.
There was a headline saying that Germany wasn't aware of that before it was announced. We could talk more about that particular deal in a bit. You pointed to this idea of a question among a lot of the bank executives around the actual credit quality. And I wonder, what does that mean for when the Fed does cut rates materially? Does this mean that they're going to be more willing or less willing to extend credit at a time where there are real questions around the creditworthiness of a lot of these consumers?
So, and it's all woven together, because if we really wanted to know the answer to a single question, you'd want to know soft landing, hard landing. If it's a hard landing, the Fed would say, gee whiz, that would support 50 basis points now, because there's a lag period in terms of what it happens when you move rates. The channel check on credit quality in the commercial space, even commercial real estate from this conference, is benign. The credit statistics are better than average. They're not even average. They're better than average. It is isolated right now to consumer. So the bulls could still argue that this is a soft landing. So I don't think it's clear that we're headed to a hard landing, even though we're talking more about the consumer. So I think it argues for 25, because I think it would send a sense of urgency that might spook the market more than not, would be the camp I'm in.
Tom, overall, did you walk away from this conference feeling better or worse about financial conditions and where these banks were?
I felt like that we need more time to hear how this plays out, because if next quarter it's worse, then the market's going to believe a trend is underway. And given all the surprises we've had in financial services, investors are inclined to wait and see. I also think it means it's a lot to do with policymakers as well. We also had the capital rules announced, which were generally cut in half, plus or minus.
Yep.
The reaction can't always be beat on the banks. The banks are only half of finance now. So if you beat on the banks, you're encouraging non-banks. So they actually have to partner with the banks. And I think the banks, all in all, have done an excellent job of navigating this COVID and post-COVID world.
My favorite stat of yours from conversations we've had over the years, when you say the banks are only half of finance right now, Can you give us the example on mortgages, where the origination comes from?
So going into the global financial crisis, banks made about, of the top 10 originators in the country, 7 of them were banks. Today, only 3 are banks. And banks didn't forget to how to make a home mortgage. Banks were started to make home mortgages, but they really don't do it anymore. And it's because the policy reaction was so severe that it's uneconomic. Now the next question should be, are we in better shape that regulated entities aren't making the mortgages? That doesn't mean mortgage companies aren't regulated, but they don't have 3 regulators like banks do. They only have 1, the CFPB. So the question is, are we in a better place? I think the answer is no. I think we have to stop being as aggressive as we've been on the banks, and there needs to be a partnership. And then also, there's been some dysfunction in some of the agencies. We have an interim head at the OCC. That's destabilizing. We also have a transition at the FDIC at an important moment in time. So this isn't about politics. This is about getting the banking system right. So the banks are also dealing with that.
Tom, appreciate your time. You're a good man. Thank you, sir.
Good to be with you.
Our thoughts are with you and the team today, that's for sure. Thank you. Tom Michaud there of KBW. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Just starting with the details of that story that Tom mentioned, UniCredit building a 9% stake in Commerce Bank and plans to enter talks with the lender. The Italian bank said that it acquired half of that stake from the German government, half from the open market. People familiar told Bloomberg that Berlin was caught off guard by UniCredit, a stake that's nearly as large as the government's. It now raises the possibility of a takeover that would reshape Europe's banking landscape. John?
Danny, I think we've got a microphone problem, so I'll pick up the next story for you. We'll catch up with Danny in about 30 minutes' time. Let's turn to this one. It's the end of an era for Campbell's Soup. The 155-year-old company announced plans to drop soup from its corporate name and rebrand as the Campbell's Company. In a statement, the CEO, Mark Klaus, said the decision is meant to retain the company's name recognition but better reflect its portfolio. Campbell's has acquired multiple snack brands over the years, including Goldfish, Snyder's of Hanover and Pepperidge Farm. And our final story, McDonald's is moving closer to completely removing human cashiers from its shops. People familiar say it's rolling out a new format in the US where digital ordering stations can take cash and give change. The bulk of McDonald's already have digital kiosks, but ones that only accept card payments. Human workers aren't going away, but the new model, which is only at a handful of restaurants, essentially removes the need for cashiers. We've been replaced by robots.
This was largely expected, but you think about how this is the most basic of the replacements, and it still hasn't gone off as much as people previously thought. But you just can imagine this is going to be the path ahead, and you're going to go to a restaurant.
You can see where it's going, of course. Up next on this program, fracking, face-off.
I will not ban fracking. I have not banned fracking as Vice President of the United States.
Fracking? She's been against it for 12 years. If she won the election, the day after that election, they'll go back to destroying our country, and oil will be dead.
Oil traded much lower in the last few days, the last week for that matter. That conversation up next. Crude bouncing this morning. WTI up by 2.5%, still trading in the 60s. Brent crude back in the 70s. Brent crude up by 2.25%. Under surveillance this morning, fracking, face-off.
I will not ban fracking. I have not banned fracking as Vice President of the United States. And in fact, I was the tie-breaking vote on the Inflation Reduction Act, which opened new leases for fracking.
Fracking? She's been against it for 12 years. If she won the election, the day after that election, they'll go back to destroying our country, and oil will be dead, fossil fuel will be dead. We'll go back to windmills, and we'll go back to solar, where they need a whole desert to get some energy to come out. You ever see a solar plant?
Here's the latest. Vice President Kamala Harris touting the record U.S. energy boom during last night's debate. Donald Trump with this to say, pointing out Harris's change of position on fracking in the key state of Pennsylvania, questions around the U.S. election and concerns about energy policy looming over the market. Stephen Schork of the Schork Group joins us now for more. Stephen, big difference in the way this market's trading. So let's sit on that just for a moment. We've talked about it through this morning. The physical market's doing one thing. Walk us through what's happening there relative to how we're pricing things in the paper market over the last week.
Yeah, absolutely. So first and foremost, of course, we're concerned about Hurricane Francine making landfall today along the Gulf Coast, the refinery epicenter. So we are seeing some reactions into the market on this event. Now, assuming we come through the event unscathed, what we're looking at now is a physical market that appears to be relatively tight here in the United States. So, for instance, the Cushing, Oklahoma terminal complex, where you make and take delivery on the futures contract on the paper market, physical barrels there have fallen in 15 of the last 16 weeks, 11 weeks in a row. The decline of over 18 million barrels is about 40% above seasonally adjusted norms. So we're seeing a significant drawdown in the physical market, and this is being reflected in the paper market in the spreads. When we look at the differential over given time periods, that we're looking at a clear premium being paid in the spot market, which is a clear indication that the paper market is telling us the physical market is way too tight and therefore not enough supply as we go into the fall turnaround season.
Just taking a step back, Stephen, are you basically saying that the decline that we've seen in the contracts around oil just simply at this point is a head fake, and that you're going to see some sort of price spike as people realize the physical dynamics at play?
Well, it's a good question, and a massive driver of the price declines we've seen over the past 2 weeks has been an incredible amount of futures contracts in both the NYMEX, New York Mercantile Exchange's WTI contract, and the ICE Brent crude oil contract, where we've seen a number of speculative shorts, mainly hedge funds, come in selling a heck of a lot of oil over the past 2 weeks. And we've also seen a lot of selling by the bullish funds, i.e. they're getting stopped out. So therefore, we have bearish hedge funds that are establishing new shorts, and that selling has been exacerbated by panicked bulls trying to cover and get out of their positions. So what we're seeing now is a bit of a squeeze in the market. I do think we are overdone. Keep in mind, I think essentially, yes, to answer your question, this is most likely a head fake. We are going into September, October, the weakest demand months of the year, but we are setting up to form a base now over the next few weeks that will set the foundation for a rise when demand begins to pick up in the latter part of the fourth quarter.
Well, given what you just said with the physical market being tight, the futures is trading November, some of these barrels. What's the floor then do you have?
A floor right now is based on our modeling, and we go out through quarterly modeling. We are right now down at the bottom of the well below our first standard deviation of our modeling, which came out in the beginning of the quarter, which was right around $72, $73. Our next bottom number in the spot market between now and the end, well, we just have a couple more weeks in the quarter, but it's we'll just round it. So $67 is the second standard deviation of our model's output. So for me, from a quantitative approach to this, 67 is our floor in the market for the next month or so.
Stephen, thank you, sir. Appreciate the update. Stephen Schork there at the Schork Group on some big developments in this oil market. The bearishness, almost overwhelming how bearish things have got and how quickly things got bearish. We've had revisions from Goldman, revisions from Morgan Stanley, fears about growth in China, whether that's misplaced or not, fears about production at a record in America and being oversupplied in 2025.
And this, to me, really goes to the heart of the question. Is this a supply issue or a demand issue? At what point are people sort of overestimating or increasing their expectations of a demand fall off in tandem with some of the weaker data that we've gotten economically out of the U.S., out of Europe, in particular out of China? We've
moved back from talking about triple-digit crude and inflation being too high, haven't we?
This, to me, I mean, look at gas prices. They've fallen off a cliff. That's the reason why even in last night's debate, it was real question about the imminence of some of these points at the same time that you're seeing oil prices decline to such a great degree.
Just waiting for shouter prices to do the same thing.
That's another story.
8:30 Eastern time. Look out for that debate when CPI drops. Coming up on this programme in the third hour of Bloomberg Surveillance, Scott Chronert of Citi, Bloomberg Sonali Basak, David Kelly of JPMorgan Asset Management, and we'll speak to Steve Ricchiuto of Mizuho. Snapshot of the price action. Equities recovering slowly, still lower on the session by a little more than 0.1% on the S&P 500. In the bond market, the rally continues for a seventh consecutive day on a 10-year maturity. Yields lower on a 10-year by 2 or 3 basis points, just above 360. From New York, this is Bloomberg.
We're seeing an elevated wage growth, but not wage growth that's going to trigger another bout of inflation.
There's a lot of reasons to think that inflation could be stickier, and the Fed is really focused on that.
The next few months, inflation, the pace and path of inflation is going to get a little more difficult.
It's underappreciating the level to which we're all going to have to live with structurally higher inflation.
I don't think the inflation boogeyman's totally gone. I think it's just under the bed for a little while.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
12 months ago, this was the most important number, the biggest data point on the planet. And this morning, 12 months later, tumbleweed. Hardly been talked about. 30 minutes away from CPI in America. Your equity market shaping up as follows on the S&P 500. Equity futures down a little more than 0.1%. The Russell, the small caps recovering, just turning into positive territory at 8:30. US inflation data on deck. Mike Wilson of Morgan Stanley put it best this morning. For him, for the team, this story's over.
If you take a look at where break-even futures are, guess what? It's over there too. Bond market saying that it's over. Roughly 48% of investors surveyed by 22V Research said that it was going to be a mixed or negligible market reaction to what we're going to be getting in about 30 minutes time. And maybe rightly so, considering the fact that the year-over-year comps have left us with a very low rate of change of inflation. Key question, what will be the biggest surprise for market? Upside surprise or a downside one?
Good question. Key caveat. And this is a key caveat. Mike Wilson talked about the price change story being over, but the price level story wasn't. And that's why you see this so still, politically charged, on the campaign trail and in the debate as well yesterday evening.
Absolutely. Trump immediately went into the price change level. That goods basically are up average 20% since Biden took office, since we've seen that acceleration of inflation. He talked about groceries, things like bacon. And this remains top of mind for American voters, which is why it is so interesting that he wasn't able to prosecute the case on the sitting incumbent on the stage with him. He waited to the very end of the debate to say, what have you been doing about it? You had 3.5 years. And even moments where he could have went into other things that poll very well for him, like immigration. He said, no, first, before immigration, first, I actually want to talk and correct everyone about the size of my rallies. That is really the deficit he had on that stage. Wasn't able to lean into the things that benefit him.
Speaking of debates, big debate here in New York City as well. Wall Street having a big debate at the Barclays Global Financial Services Conference. Do we have a problem with interest rates coming down, or do we have a problem with credit quality? Ally Financial, we keep going back to it. Problems in the auto loan book for consumers. Big issues.
People talking about how this is just a consumer issue. We heard that from Tom Michaud as well as others, not necessarily a corporate issue. But this, to me, it's high inflation to the point that you were just saying, the high absolute level, eating into consumers' ability to repay their loans, cost of living, and now more recently, a weakening employment picture. This is the reason why people care more about the labor market than inflation, because we know prices are a lot higher than they were in 2020. What we don't know is, are people being hired and getting the price increases in their income salary that they were before to keep up with that? And I think that is really the question that Ally Financial is talking about.
Futures recovering just a little bit. We're down 0.1% or 2 on the S&P 500. In the bond market, the rally continues for a 7th consecutive day on a 10-year Treasury yield to lower by 2 basis points. The 10-year 361.80. Coming up on the programme, Scott Chronert of Citi on why tariff and tax policy are the most relevant to the equity market. David Kelly of JPMorgan on why a 50 basis point rate cut could do more harm than good. And Steve Ricchiuto of Mizuho reacting to CPI data. We begin with the top story. Stocks mixed following last night's debate and ahead of today's CPI report. Scott Chronert of Citi writing the following. We argue that tariff and tax policies have the most relevant impact to US equity fundamentals. Although it is premature to analyse with high confidence, our conclusion is that higher corporate taxes pose a bigger risk to earnings than do tariffs. Scott joins us now for more. So, Scott, a range of scenarios, and you have to attach a range of probabilities to each individual scenario. What's the base case now for you and the team, and what are you advocating for when you speak to clients?
Well, the base case for us is still a very tight race to call, which I think is one of the outcomes of last night. So without weighing too far into the actual debate, let's just kind of get to, from our perspective, what really matters from an equity market perspective, and that is what impacts or influences fundamentals going forward. And from our perch, nothing really has changed. You've got two different approaches to how to navigate the economic condition from here. with Trump, as we've seen in his first term through, tariffs become an important solution for many issues. But with tariffs, what we think you get is something that conjures up the supply chain disruptions of the COVID timeframe, whereby you see the cost of goods sold element for many companies, the ability to pass through prices or price increases resulting from tariffs for others, that begins to muddle the fundamental picture. On the other side, when you start talking about raising the corporate tax rate from 21 up to proposed 28% right now, what does that do? And very simple back of the envelope math, if you look at consensus earnings expectations out to 26, which is when we presume that such policies would actually be implemented, right now consensus would say, which is very early, 12% growth in 26. At a 28% corporate tax rate, that's closer to 5%. So in both cases, our focus is on the influence and read through the fundamentals. And if for both candidates, our initial take and ongoing take actually is that they're both at the margin equity negative.
Scott, we've got no idea how campaign promises translate into legislative reality, but we do have to explore some scenarios nevertheless. You explored one. It's much cleaner to sort of analyse what Harris is suggesting. You go from 21 to 28. It's a clean lift in the tax rate. What Trump is proposing is less cleaner, 21 to 15 with conditions attached to it about where you produce. Scott, how are you investigating that one? How do you analyse any of that?
Well, I think we probably in our thinking, we give the chances of even lowering corporate tax rates pretty low. And why is that? We're still looking at a backdrop here where the deficit set situation heading into 25 and beyond is where it's projected to continue to increase. OK, and so funding the deficit is going to be an ongoing issue. When you start talking about extending the Trump era tax cuts, that's an immediate negative to the deficit because essentially current CBO projections are based on the presumption that the Trump tax cuts expire. So the starting point for all of this discussion is kind of circular. And so where we come out on this is that we're going to have this ongoing issue of funding the spending that both candidates seem fairly compelled to continue on. You're not seeing much discussion on how to control spending from this point. Not many votes in that at this point. But what it does do for us is kind of keep the ongoing focus on, OK, we have to at some point address the revenue gap that comes with funding the deficit in relation to your approaches, whether it's approaching higher corporate tax rates, lower corporate tax rates, or finding other means via the tariff approach. All told, you're right. It is a bit of a jumble, and it does put a lot of pressure on whether or not you control Congress, i.e. via both houses. The base case is that we're still looking at most likely a split Congress in the case of President Harris. A little bit less clear in the case of a President Trump. So still a lot of moving parts to navigate here. So at the end of the day, what we do is we put the election circumstance out there as a tail risk for U.S. equities. In the meantime, we've got other issues. We've got soft landing or not, which is an ongoing debate with many clients. And at the same time, you do have this AI fundamental tailwind supporting many other aspects. So again, part of this is putting the election outcome in context versus other forces at work in the equity markets right now.
Let's talk about the force that's coming out in about 21 minutes time, which is CPI, which at one point was a very big data point, now is not, at least for markets that have discounted the threat of an increasing rate of change of inflation, at least in the near term. How much do you see the biggest potential threat to markets as an upside surprise versus a downside surprise?
It's a really good question. And this is a bit of be careful what you wish for, right? Because our view, generally speaking, has been that, the inflation circumstance has many root causes, but among those was the navigation of the COVID circumstance where you essentially shut down the global economy and then took the time to restart it. I think if we've been surprised to the negative, it's that period of time has been longer than might have been expected 3 years ago. But in any event, we are here now and mostly have round tripped the inflation metrics. What you have to remember, though, is that inflation, for all of its issues, has probably been an equity positive from a fundamental perspective. What you've gotten with higher inflation was a tailwind for revenues, which has played through down to earnings. So when we start talking about the impact of lower inflation, and with it the opportunity for the Fed to begin to pivot off of its hawkish narrative, what comes with that is a transition period where we're going to be a little bit more focused on some of the tailwinds that we thought we had for equities over the past 2 years, maybe migrating down a different path, right? So at the end of the day, there's a dual-pronged approach to how to think about inflation. I think we all structurally want to see it come down to a more contained level. But at the same time, we do have to appreciate that from a fundamental influence, it's going to be a mixed picture, we think, for the next several quarters.
You make a really fascinating point that essentially the increase in the rate of inflation actually was a real boon for a lot of equities and equity valuations in terms of the prices that were being put on different things. I'm just wondering, what is the break-even rate? And I'm not talking about expected inflation in the future, but of just the actual inflation rate for it to be neither difficult for companies when it comes to pricing power or difficult for them when it comes to just some of the margin pressure?
That's also a really good question, and it's an ongoing debate internally and I think externally. You know, what's the new or expected neutral rate for the Fed, and how does that influence broader activities? The way we've thought about it and are modeling it out, to be quite honest, is that we're quite comfortable with an inflation rate in the 2 to 3% range. What that does, we think, is it negates some of the issue that we had during that post GFC timeframe when the Fed was trying to engineer inflation. We've sort of forgotten about that period of time because of COVID and the post-COVID circumstance. So, you know, trying to engineer inflation has its own issues. Trying to contain it, yet another set of issues. So we're quite comfortable in a 2 to 3% inflation range. We think that gives policymakers room. We think it gives companies fundamental room. But how that actually translates into a bond market response is kind of tricky. And that's another topic in the markets. What are the bonds? What are bonds pricing right now versus what equities? And what I would say is that kind of comes back to what we would argue is that in equity land, we're mostly pricing in a soft landing circumstance right now. You see that in earnings expectations. You see that in valuations being paid. We see it in our implied growth circumstance. So all told, what I would say is that we're going to be entering a transition period here, you know, and then we have the elections out there, as I mentioned, as a tangential issue. All of this sets up, we think, for a bit more volatility over the short to intermediate term. But ultimately, as we get further into a Fed easing regime, as they can begin to respond to more signs that inflation is, quote, contained, we think ultimately that's a constructive backdrop for U.S. equities.
Scott, if we could just come back to the election and the composition of Congress next year, are corporations taking solace in the fact that the Senate is likely going to be Republican, so there cannot be the blue sweep that potentially would be the worst case scenario for corporate earnings?
It's hard to say with one sweeping view on that, but what I would say is that because of the, let's say, the lack of conviction on whether you have a sweep for either candidate and the likelihood of sort of a split Congress, I think what that's doing is it keeping many investors at bay in terms of how you actually try to discount election influences, right? So we're still in an uncertain time, so we get lots of discussions on the election outcomes and potential impacts. But I think it's very, very difficult for investors and probably for corporates to actually establish a traditional strategy premised on an election outcome at this point. There are so many moving parts that are going to need to unfold here that you're out there, you're analyzing it, you're preparing for it. But in the meantime, you're running your business or your fund with what you know and what you see in front of you, in front of us. And that's, as I described, it's really where we are with the economic condition, getting to a Fed pivot. And then in the meantime, how do you really want to manage against the AI tailwinds that seem to be unfolding at the same time?
Hey, Scott, well said. Scott Chronert there of Citi on the latest, reflecting on the debate of last night and looking ahead to CPI at 8:30. In many ways, for once, bond investors have it easier. And this is why. It's not about what will happen. It's about what won't if Harris wins. If you get a Harris presidency, you don't get the extension of the tax cuts. That is bond positive, which is why so many people are saying that out loud. What happens on the other side, I've got no idea. If you get a blue sweep, If you present someone with a blank check, are you telling me they're not going to write big numbers on it if you get a blue sweep?
That's what a lot of people are assuming. But if they write big numbers on it, is that going to be a positive or a negative? And is it sort of flip the tables where it's going to be negative for bonds and positive for stocks? This is the reason why people don't want to get too cute with it, because good luck.
I don't think you have to get too cute. I think it's pretty straightforward. If you're going to take the corporate tax rate from 21 to 28%, and you have the ability to do that, stocks sell off initially. But if you start coming out by talking about fancy big programs, spending, lots of spending, then things change and things can change quickly. This is why we've got no idea on the other side, on the equity side. On the bond side, initially, divided government, Harris in control, no extension of tax cuts. Bonds are bid, they are this morning.
Yeah, increase in revenue, and most of the projections out there on Wall Street would say that the actual deficit would be smaller under her marginally than a Trump administration. That said, longer term starts to look very different depending on the composition, as we've been talking about.
Things can change on the morning, like literally overnight, depending on the results and the acceptance speech. We saw that in 2016. Yields are lower this morning by 2 or 3 basis points across the curve. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Spanish Prime Minister Pedro Sanchez today broke with Europe, calling on the EU to rethink the additional tariffs on Chinese EVs. Sanchez is currently traveling in China and said at a press conference that it's important to find a compromise, and added, we don't need another war, in this case, a trade war. The upcoming EU tariffs on Chinese-made EVs could theoretically be blocked if countries representing 65% of the population vote against the measure. Apollo is working on its first ETF. It's teaming up with State Street on an offering that will include private credit investments. The ETF still needs regulatory approval. State Street joins firms like BlackRock and Invesco in looking to make private assets more accessible to individual investors. And the battle between Disney and DirecTV is trudging on. Disney, which owns the ABC network, offered to reconnect its feed for DirecTV customers to watch last night's presidential TV debate. DirecTV countered, saying it would agree only if the channels would stay live through next Tuesday, so customers could also watch the Emmys and Monday Night Football. That offer was rejected. That's your brief, John.
Danny, thank you. Appreciate it. More from Danny again later this hour in about 30 minutes' time. Up next on the programme, the morning calls, plus Bloomberg Sonali Basak joins us for an update on the financials. But first, we're marking 23 years after the terror attacks of 2001. Friends and family gathering at Ground Zero to remember their loved ones. Also expected to attend this morning's memorial, the President, Joe Biden, and Vice President Kamala Harris, together with the former President, Donald Trump. At 8:46, we will have the first of 6 moments of silence, beginning when the first plane crashed into the North Tower of the World Trade Center. One hour and 10 minutes away from the cash open. The opening bout just around the corner. Futures pulling back 0.1%. The rally continues in the bond market. 7 consecutive days of yields falling. The 10-year down another 3 basis points. 361. 42 on a 10-year. I said this a little bit earlier, Lisa. We've not had a single day in the month of September where yields have closed higher on a 10-year.
There's basically been this 1-2 punch of both the data being okay, but a little bit weaker, and a Fed that's basically saying we're going to cut. The question now is just how much.
That's the latest on the bond market. Let's turn now to some morning calls for you. First up, Jefferies upgrading Williams-Sonoma to buy from hold and raising its price target to 156 from 148. The analyst saying the retailer is outperforming industry growth while cutting back on promotions. That stock is up by 0.4%. Your second call from Bank of America, cutting its price target on Ally Financial to 37 from 46 and keeping a buy rating on the shares. The analyst saying yesterday's sell-off was overdone, with bouncing back by 0.7%. And your third and final call from the team at Goldman, cutting Morgan Stanley to neutral from buy and lowering its price target to 105. The analyst saying the bank has less room for recovery than its peers in its investment banking division. We're trading softer there, lower by 1.3%. Around the table, Bloomberg Sonali Basak. Sonali, good morning to you.
Good morning.
What a few days at the Barclays Global Financial Services Conference. Suddenly it got very gloomy and very quickly.
Very gloomy, and it's interesting when you have the bank executives telling analysts here that they're being too rosy about things. Calm down, we've already made our records, don't expect records. anymore. That net interest income guidance from JPMorgan really set off a wave here. At one point, JPMorgan, of course, yesterday trading at the worst level since the middle of 2020. Did it deserve that after saying what it did? At the end of the day, the bigger problem is not just net interest income. You're seeing this over for the Morgan Stanley call from Goldman as well, that even investment banking won't be evenly distributed. So the riches being won across the rest of Wall Street are starting to become compromised. Goldman Sachs with that trading estimate going down 10%. Goldman is the king of the castle here. So what's going on with these Wall Street businesses?
There's one thing with net interest income. With investment banking revenues, everyone can cry a whole lot over that in terms of the bonus pool. There's another story when it comes to Ally Financial and this idea of a consumer that cannot pay its bills. And that is really where people's fear really lied. How much did you see that as a theme or versus an outlier with Ally?
I would say I'm more surprised it hasn't been a theme already. Because if you think about it, not only has the consumer been weakening over consecutive quarters, you only have another month until the next earnings cycle as well. So this is going to play catch up pretty quickly here. What is it going to take in terms of rate cuts, Lisa, to get people to borrow once again? The average APR on a credit card in America is almost 25%. And mortgages above 6% are not going to move people out of homes that have mortgages at sub 4%. And so you have consumers who are maxed out on credit card debt. You and I talk about this all the time. If you're at Bank of America or even at JPMorgan, your FICO scores are much higher than a lot of these other firms like Ally Financial. You have 750 to almost 800 for many types of credit products over at Bank of America. So the lower you are in that FICO spectrum, very naturally you'll be more stretched than otherwise, even if you see inflation coming down and rates coming down as well.
About 7 minutes until we get CPI, and we've been asking this question for the better part of about 3 years now, which is when rates go lower, is that good or bad for banks? And we got kind of a motley answer yesterday. What's the read-through of the people you speak to?
Well, this is pretty fascinating. One bank I would watch is actually Bank of America, because as rates go lower, their rollover in their hold-to-maturity portfolio here, the thing that's burned them for the last 2 years, is getting better by the tens of billions of dollars per quarter. And so that's the one bank where you saw the pain less than others in yesterday's trade. But the big ones, remember, JPMorgan, when they're making that net interest income, it's that credit card business. We're talking about the consumer here. And if you're a corporation, you're not going to have the same story because people have been chomping on debt like nothing's wrong. And so the levered loan market's open, the high yield market's open, the investment grade market's open, but the market is not as open for the consumer who wants to get a loan.
There's been a ton of supply. The answer, I guess, is it depends who you are. And we heard the same thing from Gerard Cassidy of RBC earlier this morning.
And it depends where you make your loans, and it depends on your deposit beta, and it depends on this, that, and the other, which is the reason why financials have been a very complicated trade.
Shanali, thank you. Look out for Shanali Basak alongside Matt and Katie at 9 a.m. Eastern Time, leading some of the coverage on the financials. Equities right now down 0.1% on the S&P 500. CPI dropping in about 5 minutes' time. Mike McKee around the table with us. Mike, just a brief preview of what we can expect from inflation data in just a moment.
Well, I said this before, economists are pretty good at forecasting CPI, PPI, et cetera. So they're looking for a 0.2% gain in both the headline and the core. That would push on a base effects basis the headline number down for the year, and the core number would be unchanged, which basically is a message to the Fed that, whatever you want to do is fine.
25 or 50.
25 or 50 is fine.
I feel like we won't settle that debate in 5 minutes' time, but we'll try. Mike McKee's going to stick with us. Coming up in just a moment, we'll speak to some economists. David Kelly of JPMorgan Asset Management, Steve Ricchiuto of Mizuho, reacting to breaking CPI data. That inflation data drops in 5 minutes' time. Equity futures a little bit softer. We're down 0.1% on the S&P 500. Check out the bond market. The rally continues from the front end to the long end. On a 2-year down a basis point, on a 10-year down 2 to 362. From New York City this morning, good morning. Inflation data up next. "60 minutes away from the opening bell and just seconds away from inflation data in America. The last CPI print going into the Fed's decision a week from today. The scores look like this. We're down 0.1% on the S&P. On the Nasdaq 100, we're also down 0.1%. Similar move on the Russell. The small caps, no drama. Switch on the board and get to the bond market. The scores at the front end of the curve, yields still falling, down a basis point or two. The 2-year, 357.73. With the economic data, here's Mike McKee. Good morning, Mike.
Good morning. We have a little bit of an inflation issue here. On the core side, we're up 0.3% during the month, just 0.2 as forecast for the headline. On a year-over-year basis, that pushes core to 3.2%, which was what was forecast. So the base effects come into play on an annual basis, and it doesn't really matter that we had a little bit faster inflation there. On a headline basis, CPI 2.5%. That's a big drop from 2.9%. But again, that's somewhat base effects. We'll take a look at what the 3-month, 6-month moving averages are, and we'll take a look at what the components of all this are, John.
I'll walk you through the first move in the market, and I'll stress what I always say after a big data point. First move, not always the right move, but this is the move. Yields higher at the front end by 3 basis points, and a suggestion, I'm sure, from many who are looking at this move, that this is the difference between going 25 and 50 at the Federal Reserve. The 2-year up 4 basis points, the 10-year up 2 basis points, the dollar a little bit stronger, dollar yen unwinding, almost unchanged now on the session on dollar yen at 142.30, and equities pulling back, Lisa, on the S&P 500 by 0.6%.
I don't usually say this. Usually bonds are the best indicator, always the most interesting asset class, 100% the ones you should watch. But I will say that this reaction in the equity market is more interesting because the idea of a 50 basis point rate cut being taken off the table somehow is negative for equities that maybe we're baking that in a little bit more. That's the only assumption I could possibly imagine at a time when some people were saying that actually disinflation would be a bigger risk to stocks than a little bit of inflation.
There would be the belief, not necessarily mine, that this could constrain the Fed put and constrain their ability to respond to downside risks or get ahead of potential downside risk materializing. That's the way this will be seen this morning. So yields up at the front end by 5 or 6 basis points. Equities down, particularly on small caps. The Russell down by 1%. That makes sense if that is what you believe. We'll see what we get a week from today.
Yeah, but it doesn't make sense if you believe that actually this is a gauge of the fact that demand isn't falling off a cliff and that the economy isn't struggling and that people are still spending and you see real wages tick up. So you can kind of pick your narrative. Right now, the narrative is that the Fed put might not be as strong as it was. And I believe that what you're saying right now is very much was being priced in. This is a confusing moment, and it just highlights how the reaction function of markets is not very clear. It's the reaction function of the Fed, which is maybe a little bit more clear, although unclear on the magnitude.
Bonds still falling, yields still rising, up by 5 or 6 basis points. The 2-year 365, the 10-year, just bear in mind, before today, every single day in September, the 10-year yield has dropped. It's up by just 2 basis points right now to 366. We've had a big rally in fixed income. Mike McKee, you've had a couple of minutes to go over the numbers. What's screaming, jumping off the page to you?
Well, the inflation we're seeing in this report is basically where we have seen it all along. Now, used cars and new cars prices were not really changed very much. New cars flat and used cars down 1%. But owner's equivalent rent up 0.5%. That's an increase from the prior month, and it is so large as a component of CPI that is what the BLS has really pushed up the core here. The motor vehicle insurance number up 0.6%, still rising a little bit less than it had been. Airfares up 3.9%. On the other side, we have energy commodities like gasoline down 0.6%. You probably knew that at the pump. And food, which of course has been a big argument in the political world. Food at home flat, grocery prices flat after a 1/10 gain last month. So really, grocery store prices aren't rising, at least according to the BLS. I'm sure you get people at the checkout counter saying, oh, it's still so much more.
Yeah, especially the computers that are checking you out. I am wondering, though, about the housing component. That, to me, is really significant, given the fact that there are people who challenge whether this is a lagging indicator, whether this is an accurate reflection, and how much really what some people would say is a broken housing market has contributed to the stickiness of inflation. How much is that essentially what you're seeing in the data?
Well, the housing, if you took housing out, and I can't do the math in my head, but if you took housing out of this, you would probably have a very close to flat CPI for the month. And I think that's what the Fed is going to do because they know they're not affecting that at this point. It's supposed to be coming down. And then if you look at the rest of the world doesn't do housing like the U.S. does housing in CPI. And so you can make a case that underlying inflation, which is what officials at the Fed are making, that case, underlying inflation is still coming down.
Given what's going on, though, with core, how difficult would it be for Powell to really gain consensus for something like a 50 basis point cut?
I think it'd be harder for him to do that. Part of it is image. the optics of what you're doing. And if you have to explain it and try to convince the American people, they don't focus enough on this stuff to really buy it and to listen. So the easy story to tell is the 25 basis points we're seeing inflation come down. The job market is still good. The economy is still good. We can start the cutting cycle now. But it doesn't look like there's an emergency in the economy, and it doesn't look like inflation is going to go shooting up again.
Mike McKee, thank you, sir. Very, very marginal stuff. The wrong kind of upside surprise. Core CPI coming in at 0.3 month over month. The median estimate in our survey, 0.2. I have to say the overwhelming majority of economists were looking for 0.2% in our survey. The market reaction to all of this, equities down by almost 1% on the Russell on the small caps. At the front end of the bond market, in fact, throughout the bond market, the whole yield curve now shifting higher by about 4 basis points on a 2-year to 364. With that move, as you might expect, some dollar strength. So dollar yen turns around off session lows. The dollar buying you essentially a little bit more Japanese yen after this, as if you needed any more. Dollar yen right now at about 142. David Kelly at JPMorgan Asset Management and Steve Ricchiuto of Mizuho join us now for a little bit more. David, let's get into the data first and your reaction to it. Is this noise or news for the Federal Reserve?
I think it's more noise than news in the fact that the core number was slightly higher than expected for the month. If you look at it, we got a 3.9% jump in airline fares. They're very volatile. They were down last month. They're not, given the number of people traveling, frankly, it's amazing that we don't have more airline inflation. We also got a bump in tobacco prices, which are pretty volatile month to month. But outside of that, it's very much on track. And I've been talking for a long time about, how the economy is, or how inflation is cooling. It's just cooling too slowly. Well, I can say that it is now cooled to room temperature. I mean, at 2.5% year over year, there really is not a significant inflation problem. I realize that, shelter is going to take a little while to come down from here. But even on things like auto insurance, 0.6%, at least it's coming away from a 20% year over year gain. So overall, it looks very well controlled to me. It looks like we're not seeing deflation. We're just seeing a gradual disinflation. The inflation is gradually coming out of the system. And frankly, unemployment 4.2%. CPI inflation 2.5, add those together 6.7. That's better than it's been 85% at the time over the last 50 years. So it's really not a bad economy. It's a good economy, and I don't think it calls for any drastic Fed action. I'd be very happy to see 25 basis points next week.
So we're in the quiet period. We've got all the data now. Given what you just said, David, does this reinforce the case that we get 25? I know you'd be happy to see it, but do you expect it?
Yes, I do, because I think the Fed must be aware that if they go aggressive here, they're in danger of undermining consumer confidence. And honestly, the economy is doing exactly what they wanted to do. It is settling into a softer expansion, a slower expansion. That's what they want. So they only have to gradually return to normal on interest rates.
This, to me, is a really interesting moment. David Kelly and Steve Ricchiuto, I think, are going to agree. Steve Ricchiuto is here. And is this something that you kind of agree on, that 25 basis points is the appropriate and logical conclusion from this data we just got?
Yeah, 25 has been our call for quite some time. We haven't changed it. We didn't fall into the overall concept of 75 basis points or 50 basis points. This rate cut arms race that my colleagues on the street have been engaging in, I think, has been counterproductive. I do think the reality of the situation is one where, it is a healthy economy. And that really goes against the point of, well, then I really can't get into the inflation numbers and throw this and that out and say it's really going nowhere or it's room temperature. And taking out the household component of this, the rental component of this, I also think is wrong. Because when you look at the dynamics of the rental market, we were all worried about the excess build of residential real estate. And guess what? It's all being used up. So I don't think rents are going to be something that comes down. And I think it's indicative of the fact that the economy is fundamentally healthy. And a 4.2% unemployment rate is low. And therefore, it is a healthy economy. So the Fed should be moving people's expectations back from these large rate cut discussions into a much more gradual, steady approach at getting back to neutral and really begin the debate over what is neutral. Because their number of 2 3/4 is much too low.
Yeah, no one really wanted to engage with that in any kind of verbal way. In Jackson Hole, I am curious if you're surprised by the market's reaction right now that equities are lower, at least initially, understanding it's not always the correct move or the one that's going to stick. But does it make sense to you that it would be lower by taking 50 basis points, maybe a little off the table?
Yeah, because if I have a possibility of the Fed overstimulating, I'm going to have a bit more inflation. And if I have a bit more inflation, guess what? I'm going to have better earnings. I'm going to have a stronger economy and better earnings. So I think, as Jonathan was talking earlier, I think what the market is really doing is saying, okay, we have a really good economy. We know we can get this level of earnings. If they're going to really push this thing with 50 basis point cuts, as a lot of people want to anticipate, we're going to have an economy that is going to potentially accelerate in 2025. And I could potentially think about raising my 2025 earnings numbers, not cutting them.
Steve,
from 15%.
When you talk, you sound that rosy. The economy's doing very well. Do you think there even should be a rate cut?
Look, you've reached, you've reached a point in the cycle where inflation has come down to a level that you could begin the process of normalizing rates. The real question is, where is that level of neutral rates? And this is the debate, to me, that really matters, because I think the neutral rate is 4%. A 2% real return, a 2% inflation target, assuming they can get there, 4% Fed funds rate. The Fed is thinking 2 3/4. The market is thinking 2.5 to 3. So they're basically in the 2 3/4 category. That's much too low. And if we get to that subsidy level of interest rates, then you wind up pushing the economy. And I think this is where the Fed is not doing its job. The Fed really wants to believe that we're going back to that post-financial crisis, pre-COVID period of exceptionally low levels of interest rates. And I just don't see us getting there, because that was a unique period in time where we had what? We had a debt overhang, we had a bank restructuring, and we had a massive tax increase.
Steve, you're echoing something that we heard from Torsten Schork. He was basically indicating the same thing. He was asking the question as to whether we are actually sufficiently restrictive. David Kelly, I know you've got thoughts on this matter, so let's discuss it with you as well. Where's neutral? How are you thinking about neutral?
Yeah, I know Steve and I are supposed to disagree, but I think we're quite close in this one. I would say 3.5 to 4%. I mean, if you look at the 50 years before the great financial crisis, the federal funds rate averaged 2 percentage points above core CPI inflation. If we end up at 2% on inflation, I have no problem with the federal funds rate at about 4%. But I do think that, and I think the Fed's long-term target will probably gradually go up. It certainly should. But I also think they should gradually move rates back down to that level, because I think we are suffering today from the aftermath of interest rates which were way too low between the great financial crisis and the pandemic, and that caused an enormous inflation in home prices and other asset prices. The carrying cost of crazy was zero, and so we've got a lot of crazy bets out there. Now, I think a lot of Americans are locked out of the housing market right now because home prices are too high given a normal level of mortgage rate. So I want them to, if there's nothing wrong with the economy fundamentally, if it's basically on the right track, you shouldn't have an active policy either way. You shouldn't be restrictive. You shouldn't be stimulative. You should get back to neutral. And neutral is less than 5.25 to 5.5% of the federal funds rate. So they should get going, but they should go slowly, because there's no need to upset anybody here. Just gradually get back to neutral.
Bond market's still falling. Yields up now by almost 10 basis points at the front end of the curve. On the 10-year, up by 4 basis points. And that 2-year, 10-year, just turning negative. Just briefly, we'll see if that sticks for the 5th time on this programme. Steve Ricchiuto, I want to come back to you. You touched on it, the differences between now and 2019. The difference between where you think neutral is and where the Fed is, anywhere between 100 and 150 basis points. Why are they still there in the twos? Is it because they don't want to have the conversation yet? They don't want to signal where things are? They haven't thought about it? Or do they truly believe this is where neutral is?
No, again, I think the policymakers that you're looking at are political economists. And getting back to that low level of interest rates allows them to do things that they would like to do. It allows them to try to create an environment where they're going to try to rebalance income distribution, and they're going to try to grow the employment rate and grow wage and salary income to make up for the shortfall that was created by the COVID inflation. And I think this is their underlying motivation. I can't argue with the motivation. I can argue with the tactic to get there. I don't think the aggressive adjustments or the fact that we have to get to lower levels of rates are going to do it for them. I think they're better off doing, again, David and I agree, doing a very gradual approach to allow the economy to adjust to this, allow the economy to move on its own basis, not based on policy stimulus. This is a Fed that I think wants to add policy stimulus in 2025 when there's going to be less fiscal policy stimulus. And then when we get a new president, we get a new budget, we're going to have fiscal stimulus in 2026. So they're going to try to juice the economy as long as they can because they believe global deflation bails them out.
I'm not sure if I should be happy or nervous that you both finally agree. but this is what we've got.
Scared.
David Kelly, Stephen Ricchiuto, to the both of you. Thank you, guys. Appreciate it. Inflation coming in just a little bit hotter than expected. Lisa, at the front end of the curve, we're seeing a sell-off in bonds and a bit of a pullback in equities as well off the back of this.
You know, it's interesting. You were talking about that 10 basis point move in yields, and that sounds like a lot, but based on recent moves, it hasn't been that much. I wonder if this is the new normal, right? That without some sort of guide from the Fed, without some clarity, if this is the kind of move that we're going to see on an ongoing basis.
Are you expecting to see some notes that now say 25 instead of 50?
Pretty much across the board. That's what the market's saying. If you look at world interest rate projections right now, there is about 29 basis points of a cut being priced in. Basically, it's 25 basis points that's being priced into the market now.
Certainly feels like that's the base case as this market prices out the more aggressive tone at the front end of the curve that we've seen build up over the last month. We're up by 9 basis points on a 2-year to, let's call it, about 360, 370. We pause now for a moment of silence, being held throughout the city of New York and across this country and around the world in remembrance of the September 11th terror attacks. At this time, 23 years ago, hijacked American Airlines Flight 11 struck the North Tower of the World Trade Center.
Right, quick, march.
Minutes away from the opening bound, pulling back by 1/3% on the S&P 500. A little bit more on the small caps this morning with a sell-off in the bond market. The 10-year is looking at a yield that's higher by 4 basis points. The 2 years down and yields are up by 8. In foreign exchange, the dollar is now stronger. Dollar yen had dropped to 140.71 earlier in the session. It's now back at 142.40. We had some economic data about 20 minutes ago. CPI coming in hotter than expected, 0.3%. Month over month, excluding food and energy. So that's the core print. We were looking for 0.2. That very marginal difference, apparently the difference between the Fed going 25 instead of 50 a week from today. We'll have that conversation in just a moment. As we count you down to the opening bell, a couple of things to watch for the markets in the next couple of days. Here's your trading diary, the calendar, the agenda. Tomorrow we'll get an ECB rate decision, US PPI data plus another round of jobless claims. And on Friday, UMich consumer sentiment report comes out as well. And Mike McKee's with us around the table still, our economics and policy correspondent. Mike, that was the last CPI print going into the Fed decision a week today, there is a feeling that this shifts away from 50 and shifts the conversation towards 25.
It wasn't definitive, so it didn't make a real case for 50 basis points. But I want to go back to what we were talking about earlier with the impact of housing on this. And if you take housing out, how inflation has really come down. You look at the 12-month rates, and we talked about that, 2.5% for the headline, 3.2% for the core. That includes inflation a year ago, which is not relevant to the Fed anymore. You take a look at the 6-month moving average, and it's 2% for the headline and 1.8% for the core. And then if you look at the 3-month, the most recent 3 months moving average, 1.1% for headline CPI and 2.4% for core. So inflation has really dropped. And if you look at those numbers and think about how PCE translates, 3, 4, 5 basis points lower, the Fed is in a good position to cut. If they felt there was a need, they could point to those numbers and say, we could do 50.
Right now, the market is saying they won't. Right now, the market is saying they're going to go 25 basis points because that way they can go gradually and kind of not spook anyone. Is there any data between now and a week from now that could change this picture? University of Michigan sentiment survey, anything that really could potentially tip the difference?
I don't think so. There hasn't been any indication. We saw the New York Fed numbers on inflation expectations. They didn't move really. The Michigan expectations numbers, even if they move, wouldn't move all that much. So I don't think that would be the only possible thing that could derail it if people suddenly said inflation was coming back. But with these kind of numbers, you don't think that's the impression that people are going to get because food prices, as we said, leveled out. Gasoline prices went down.
So, Mike, are you calling it? It is no longer debate. It's 25?
Oh, I did that on Jobs Day. But yeah, I think 25 basis points because that's the Fed's kind of base case. They're risk averse. They are in the process of managing risk, and they would rather do 25 and see what happens rather than do 50 and then have some sort of surprise where they'd have to backtrack. So I think at this point it is likely to be 25 unless there's something we don't know about, which of course gets to that argument of what do they know that we don't know.
Of course, not much. There were 2 Chairman Powells in the summer. One Chairman Powell suggested the labour market was strong and that's a reason to wait, a reason that we can be patient. Then Chairman Powell in Jackson Hole, Wyoming sounded like a 50 basis point rate cut chairman. Which chairman do we hear from next week after that inflation report?
I think you'll hear more of the 25 basis point chairman, but one who expresses confidence that inflation is now going to get to their target, and so they therefore can continue moving. And then you look at what Chris Waller said about if we see further data showing the weakening of the economy, we could front load, we could go to 50. So that'll be on the table for a while till we see all the data ahead of the November meeting.
We hear a little bit more from the man from Sintra and not the man from Jackson. Is that fair?
Probably. What I'd like to see is actually dissent. What I'd like to see are some of the people who are calling for 50 basis points and saying just to make things accommodative right now. Austin Goolsbee, for example. Austin, I'm looking at you. Chicago Fed president. If you dissent, I think that would be a valid way to sort of represent that people do have different views in the FOMC committee. Just suggestion.
Who are the voting members you're looking for that might dissent next week?
I think the only one that would be a possibility would be Mickey Bowman. She's been fairly firm on that, but the problem is she's a Fed governor, and we haven't had a governor dissent since 2005. So it would be seen as a big deal, so she would have to really feel like it was important to make that case.
19 years. Sure. Yeah. 19 years since a governor dissented on the FOMC.
But this is the issue. They clearly disagree with one another. What's the problem, right? Why not just represent the views in something other than commentary, just to highlight, look, we're not sure. So, don't read too much into this. We're just humans.
This bond market keeps selling off. Yields are higher by 7 basis points. The equity market a little bit softer. Lisa, as you look at things going into the opening bell, what jumps off the page for you?
I want to see equity response to the idea that the Fed isn't going to necessarily cut by 50 basis points. That, to me, absolutely the most interesting.
How constrained is that so-called Fed put?
Yeah.
I think that's a big question for us all over the next week. Coming up tomorrow, Sharon Bell of Goldman Sachs will catch up with Mohammed Al-Aaron of Queen's College, Cambridge, Mike Schumacher of Wells Fargo, Lindsay Piegza of Stifel. From New York City this morning on September 11th. As we often say, time may pass, we will never forget.